Ladies and gentlemen, please take your seats. The program will begin in 5 minutes.
Just like the sunrise needs the sky, just like the blackbird needs to fly, I gotta have you by my side, 'cause you make me feel alright. I know some people play it cool, but baby I ain't that kind of fool. When I'm with you, girl, there ain't no rules, 'cause you make me feel alright. I thank my lucky stars that life turned out this way. No matter where we are, I know this love is here to stay. Well, I've seen good times and I've seen bad. There've been some happy, there've been some sad, but you're the best thing I ever had, 'cause you make me feel alright. Just like the sunrise needs the sky, just like the blackbird needs to fly, I gotta have you by my side, 'cause you make me feel alright. I know some people play it cool, but baby I ain't that kind of fool. When I'm with you, girl, there ain't no rules, 'cause you make me feel alright. You make me feel alright. Hey, 'cause you make me feel alright. Yeah, you make me feel alright. You make me feel alright. Hey, you make me feel alright.
Ladies and gentlemen, please take your seats. The program is about to begin. please welcome Henry Blodget.
Thank you, everybody. Great to see all of you. Welcome. We're so happy you're here. And I just want to start off with a thank you. This conference exists because of all of you and our incredible sponsors and great team at Business Insider that puts it together. It takes a long time to do it, so we're so grateful to everybody. And this is the 8th one. Thrilled to have you here. Okay, so I'm going to kick us off with something called Better Capitalism. And I'm going to start with a quiz. But it's early, so I'm not actually going to make you answer it. I will give you the answers. So, what is the purpose of a company? If you ask people that these days, you will usually get the following answer. To make money for shareholders. It's a simple answer. It's done a lot of good for the economy and a lot of people. It is not, I would submit to you, the best answer. Here is a much better answer. The much better answer is that we could create value, companies create value for several constituencies, not just shareholders. Shareholders, employees, customers, and society. And let me just ask a favor. Is it possible to put the slides on the monitors down here too? That would be very helpful. I don't have to keep staring up at the screen. This is not a new idea. This is an idea that actually has come into our society over time, several times in the history of the United States. If you remember your economic history, 1900 to 1930, it was this great capitalist orgy. It was all about the shareholders and making money. And then we got to 1929. It was a huge disaster. Everything collapsed because all the money had gone to the top. We realized, hey, actually have to take care of the people who work. We redistributed things a little bit. 30s, 40s, we get into the 50s and 60s, and these were actually the heyday of what you might describe as stakeholder capitalism. Companies thought in those days that your job was to serve multiple constituencies, not just shareholders. Frank Abrams here, chairman of Standard Oil, said it very well. We have to balance the interests of these different constituencies. So we were puttering along 1950s and 60s. That was going very well. But then we came to a new idea from Dr. Milton Friedman, an economist. Dr. Friedman said, the social purpose of a company is to increase its profits. That's it. As you can imagine, this was music to the ears of a few members of our society who said, finally, I don't have to worry about any of that other crap. All I have to do is increase my profits, and I'm doing my thing for the society. This was in 1970. Takes ideas like this a while to percolate. But by the time we came to the 80s, after a terrible decade for business and the stock market moved sideways and then went down. The misery index was super high. Inflation was running wild. It was a terrible time to be a shareholder. We get to the 80s. This idea is starting to take hold, and we suddenly have a new role in our society, activist shareholder. And this role was immortalized in a movie in the mid-'80s called Wall Street. I don't know whether you saw it, but it was a big cult movie for a lot of folks in my generation coming out of school. There is a character in the movie named Gordon Gekko, and he is the original activist shareholder. And I want you to imagine that we are at a meeting of the annual meeting of Teldar Paper. And you are all shareholders of Teldar Paper. And you are pissed because Teldar Paper lost $100 million last year. Your stock has done horribly. Up on this stage are 33 vice presidents, who Gordon Gekko is about to inform us, all make over $200,000 a year. It's quaint, I know. And Mr. Cromwell, who runs the company, has a salary of $1 million a year. Absurdly low salary for a CEO today, but gives you the picture. Gordon Gekko takes the microphone and he takes over. He's supposed to be this big villain. Here's what he has to say.
The new law of evolution in corporate America seems to be survival of the unfittest. Well, in my book, you either do it right or you get eliminated. In the last 7 deals that I've been involved with, there were 2.5 million stockholders who have made a pre-tax profit of $12 billion. Thank you. I am not a destroyer of companies. I am a liberator of them. The point is, ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the evolutionary spirit. Greed in all of its forms. Greed for life, for money, for love, knowledge, has marked the upward surge of mankind, and greed, you mark my words, will not only save Teldar Paper, but that other malfunctioning corporation called the USA. Thank you very much.
Greed is good. This became the rallying cry for all shareholders. It was the first class offered at every business school. It is all about increased profits. That's what your job is as a company. And by the way, in defense of Gordon Gekko, and all of you, the shareholders of Teldar Paper, Gordon Gekko's speech was right in the middle of this chart. This chart is showing corporate profitability as a percentage of the economy, and we were at a really crappy low in the mid-1980s. Corporations were fat, they're bloated, they're getting killed by Japanese corporations and others. We needed to, for lack of a better word, kick Mr. Cromwell in the ass and get Teldar Paper moving again. And it worked. Look what happened to corporate profits over the last 25 to 30 years. It's been an extraordinary run. Why do we do that? Because we minimize costs. This is wages as a percent of the economy. We're going to come back to this because it's very important. Stocks, as a result, have gone to the moon. That little flat line all at the end, that's right up to Gordon Gekko, and then boom, to the moon. The people who own stocks in our companies in our economy have crushed it by every measure. Top 1%, top 0.1%, the 0.1% share of the economy, the bottom percent chart here, what you see is 0.01% now taking home 5% of the income in the economy. That is equivalent only to the era in the late 1920s known as the Gilded Age. So people who own stocks have done great. But there's a problem. Especially in the last 20 years, US economic growth has slowed. Why is that? Well, there are a bunch of things going into it, but here's one of the problems. This so-called shareholder capitalism, this religion that we've developed over the last 35 years, almost all of the gains in shareholder capitalism go to the top. Consumer spending accounts for about 70% of the spending in our economy, and consumers cannot spend when they are broke. Our economy, I would submit to you, is an ecosystem. Every bit of cost at Business Insider and all the millions of other companies in the economy is revenue for other companies. The money we pay to our employees, the money we spend buying stuff, that becomes revenue for others. It's all recycled. We are all in this together, and we are not, with shareholder capitalism, taking care of everyone in it. And this chart really brings it home. Again, most gains in shareholder capitalism go to the top. This shows the last 35, 40 years. There is such a thing as trickle down. This was very popular in the 1980s when this idea was being sold by our politicians and others. Don't worry, give all the money to the top. It'll trickle down. Here's the thing. It does trickle down. There have been income gains at the bottom, for the bottom 85%, 8 out of 10 people, but it really is a trickle. It's about 1% a year, whereas the top, 4, 5, 6% a year over the last 30 years or so. And most of those gains, by the way, in case you're getting disgruntled about your 1%er friend, actually go to the tippy top, the 0.01%. The folks who are just in the generic 1%ers who will make somewhere on the order of 400 grand or up per year, they're doing fine, but they're not just raking it home every year. The 16,000 people in the 0.01% are making $30 million a year, which is up from somewhere around $1 million 45 years ago, or 40 years ago, rather. They're worth about $371 million apiece. They are doing great. And again, no issue. This isn't about it's terrible to be rich. Of course it's not. But we want the economy to work for everybody. So the bottom 90% in the economy spend everything that they make, just about. The problem is it's not enough to drive this economic growth. Spending is oxygen in the economy. That's what all companies feed on. The 90%, 9 out of 10 people are spending just about everything they make, and here we are struggling along at about 2% a year growth. Meanwhile, the tippy top, well, they'll just be altruistic, and they'll spend a lot, and that'll save us. And it's true. If you have the benefit of being in the 0.01%, please spend everything you can, because that's how you redistribute it. You make money for other companies. Other people get to share in the money. It's great. But it's actually difficult when you're worth $371 million to spend it all. And I'll give you an example. Let's take a hypothetical 0.01%er. Very altruistic, wants to spend it all, not very ambitious anymore, invests just in treasuries. Okay? That produces an income of about $11 million a year. Well, let's spend as much as you can. We'll go through the essentials. Food, let's say $3,000 a day. Take lots of people out to dinner, lots of restaurants all day long. That's a lot. 3 massive houses that cost you $1 million each to heat and furnish and all that stuff. Clothes, $2,000 a day ought to cover it. Clothes are expensive. Cars, you probably need 5 really nice new cars every year just to play out and give them away. Education, super expensive. We'll spend $1 million a year educating 10 kids. Health, very expensive also. Yacht, you got to have a yacht, just a medium-sized one. We don't want to go over the top here. That's probably about $1 million. I don't know how much yachts cost, but I imagine the operating costs are high. Jets, same thing. We're not talking about the purchase cost. We're talking about paying the pilots and buying the gas and all that stuff. It's probably about $1 million. So you bring all that together along with another $3,000 a day of incidentals. You've still only spent $10 million. You can't do it all. And there are lots of people who have a lot more than $371 million. So it's tough. And what they're doing is just passing the money back and forth, investing it in others, buying stocks, and so forth. So the tippy top can't save us. So then you say, well, it's a jobs problem. We just don't have enough jobs. It's the robots. They're stealing all the jobs. Again, that is a bunch of crap. There are plenty of jobs in the economy. We have an unemployment rate that is lower than it has been in more than 50 years. There are plenty of jobs. The problem is the pay issue. This, again, is what's happening in our economy. This is wages as a percent of our economy. Companies have gotten so good at not paying people much that wages as a percent of the economy has dropped. We have forgotten that the reason, one of the big reasons companies exist is because of the people who work for them. We are a big constituency. So this is the problem. This is why our economic growth is so slow and why so many people in our country are so angry. If we can fix this problem, I submit to you, we will actually make America great again. Any good religion comes up with myths that help perpetuate it. The people who are really adherents of the myths believe them, and they tell them, and they persuade people. So there are lots of myths about shareholder capitalism. The first one, employees are just costs. It's just a line on a spreadsheet. You've got to minimize those costs. No. Employees are actually the ones who create the value in the economy. And they are also the country's customers. They're the ones that spend the money. They're not just costs. Myth number 2, and this is a good one. I know you've heard this. Rich people create the jobs. It's like it's not enough that when you create a company, you have this incredible privilege of leading the company and you're probably doing well financially and so forth. You also have to create this myth that it's somehow super altruism. You are the job creator supporting everybody else. Henry, it must be amazing. You have created 500 jobs at Business Insider. It is amazing in one way. It is a huge privilege to be working with 500 people. I cannot believe that we are here from where we started, which was just one guy in the loading dock of another startup. It is a huge privilege. So forth. I did not create those jobs. All of you who read Business Insider, buy advertising on Business Insider, buy subscriptions, you are the ones who created the jobs. I was important. Our initial investors were important. They gave us the startup capital. But as we find out with a digital media company, every week it seems, investment capital and founders are not enough to keep the company going. What keeps it going? The healthy ecosystem. If you don't believe that, you think of yourself, I am the seed from which all the value grows. I created the jobs. Try planting your seed on Mars or in a desert. Doesn't work. You need the ecosystem. Shareholder capitalism myth number 3. Everyone benefits when stocks go up. Actually, no. Only 50% of Americans own stocks, 52%. The top 10% own 84% of that value, and the top 1% own 38%. So really, that 10% benefits. Shareholder capitalism myth number 4. What? It's not. You have to keep wages low. They're just a cost. It's a law of capitalism. No, it isn't. You can pay people whatever you can afford to pay them without going broke. You do have to avoid going broke, and you have to avoid getting fired, and your shareholders may, in fact, say, no, we're not going to just triple everybody's salary because there's enough money. We need some money, too. Fine, it's always a trade-off, but there's no law of capitalism that says you have to pay people as little as possible. Then people will say, well, no, if the problem is the loss of manufacturing jobs, there's nothing we can do about it. Again, a bunch of crap. The only reason manufacturing jobs matter is they used to pay well. And why do they pay well? Well, in the beginning of the century, they actually paid terribly. They were horrible. People quit them all the time. Workers were abused. You couldn't afford to buy anything. Henry Ford came along very famously and said, I'm sick of this turnover. We're going to double the pay to our workers. He doubled it. Now they can afford to buy cars. It's good. They become customers, and they don't quit all the time. It was not actually about buying cars. He was trying to reduce turnover. It worked. But this is how we got into paying people well and treating them well and so forth. So it is not the loss of manufacturing jobs. McDonald's could pay people $15 an hour. There's no law against it. It's just that the shareholders aren't quite on board for that yet. The last shareholder myth, if you don't maximize earnings, your stock won't go up. No. Look at Amazon. This is the most famously no and low profit company in history. Stock has gone to the moon. As long as you are creating value, shareholders recognize that, stocks reflect that. So basically, 40 years of shareholder capitalism have turned us into a nation of overlords and serfs. And if you look at the line on the left, that blue line is the United States. So we are great in one respect relative to a lot of our friends in other countries. We, in the United States, the 1% make a lot more of the pie than in every other country. And again, if you're a member of that, that's good news. For 99 people, it's not. So what is the answer? Quickly. First, the answer is not communism. I hear this sometimes. Well, we're going to throw it out. Capitalism sucks. Let's just redistribute everything. It's got to be communism. Communism doesn't work very well. Very good symbolic representation of this is the Korean Peninsula, South Korea, nice capitalist country on the bottom. North Korea, command and control, Rocket Man on the top. That little light maybe up there, maybe that's Kim Jong-un's weekend retreat, because as we know, from Animal Farm and everything else, communism never quite works the way it's supposed to idealistically and so forth. Communism is not the answer. The answer is better capitalism. Create value for shareholders, employees, customers, and society. Don't just make money for shareholders. How are we doing at that? Well, shareholders are doing spectacularly well. No worries there. Society is doing much better than it used to be. This is New York in the 70s, New York in the 2000s. I grew up in New York in the 70s. Why anybody in our government is recommending that we strip away environmental laws, I have no idea. It sucked back then. It is great now, and companies are doing fine. So we should stick with what we got. We do need some rules. This idea that it's just Lord of the Flies, not going to cut it. Customers are doing amazingly well as long as you can afford to buy products. It's just an extraordinary array of amazing high-quality products we've got available to us now. It's employees that are still suffering a little bit, consumers. Federal minimum wage, $7.25 an hour, hasn't been moved very much. $15,000 a year, not a lot these days. 40% of jobs in the US pay less than $15 an hour. Walmart's operating profit, just as an example, $22 billion. It's not like this company is suffering, but their starting wage is $11 an hour. That's below the poverty line. It just doesn't feel quite right. I would suggest that Walmart could share a little bit more with employees. So that is the main message. It's time for us to share a little bit more of the value with those who create it. Make those lines flatten a little bit. Profits come down, employees make a little bit more. This would be good for the economy. Recently, some promising signs. Seattle raises its minimum wage to $15. Huge number of people religiously defending shareholder capitalism. They, it's going to destroy the economy. You just killed jobs. Nope. There was a report that came out a year or so afterwards that gave hope to those people saying it will destroy the economy. Turns out the methodology was flawed. Seattle is doing fine. Walmart is raising its wages, which is great. JP Morgan is raising its wages, others as well. Amazon's the biggie. This was the announcement very recently.
So the fact that November 1st, we are also establishing a new Amazon minimum wage of $15 an hour.
That's $15 an hour. People say, oh, well, Amazon, you're just being criticized, you're doing something for the PR. They were smart enough to have a camera there for the announcement, but those folks were genuinely stoked because a few dollars an hour when you're making 11 means a huge amount. It's why they are so psyched. So if we can just do this across our entire economy, we are going to be in great shape. And I'm so happy to end with the fact that there is a new Gordon Gekko, and it is Larry Fink at BlackRock, and he's the good Gordon Gekko. It's what's needed in society right now, which is Larry Fink is now carrying the flag for better capitalism, saying that companies have to make a positive contribution in society. They've got to take care of all of their constituencies, not just shareholders. If every company does that, we are going to be in great shape. Thank you. Have a great day.
Please welcome Drew Houston and Paul Graham with Allison Chantel.
Left end of the sofa. There you go.
All right. Good morning, everybody, and welcome to you too. On stage, we have two of the best entrepreneurs in the world. Directly to my right is Paul Graham, who co-founded Y Combinator. He's an established author, writes amazing essays about entrepreneurship on the web, and before all that, he started ViaWeb, which sold to Yahoo in the late 90s. And just a little bit about Y Combinator. It's the most prestigious startup accelerator in the world. They've invested in over 1,500 startups since its founding in 2005. 19 are worth more than $1 billion. 93 are worth over $100 million. These startups include Reddit, Airbnb, and Dropbox. And so that brings me to Drew Houston, who is the founder of Dropbox, co-founder of it, built a $10 billion business in his 20s and now his 30s. He's got over $1 billion in annualized revenue, over 500 million users. Can I get a show of hands for how many of you have used Dropbox over the years? Yeah, everyone. There we go. So this is the man who made that. So welcome to you both. Thank you for being here.
Thank you.
Yeah, so I want to go back. You guys met a little over 10 years ago. Drew, I think, flew boldly across the country, completely uninvited, to show up at Paul's desk. So was this not a good first impression? What was that about? What did you think of each other?
It doesn't really scale very well to crash Y Combinator, so Drew never fails to remind me about this, but I was not very friendly. I mean, Drew said, "Can I just demo it to you?" And I said, "No." Because that's what the application process is for, right?
Yeah, so there's a little bit of backstory before this. So I had a friend from MIT who had done Y Combinator the year before, and he had this amazing experience, and it was like his company, he started a company and moved out of Boston, and it was like his company was in the fast lane. Like they were raising millions of dollars, and I felt like, I'd have these calls with Adam, and he would, he'd be like, "Oh, you have a Node Coastal just gave us a term sheet for $5 million.
And he had been Drew's little brother in his fraternity.
Yes. And I'm like, well, I had like the eel special at the mall food court sushi place. And I'm just like, oh my God, I gotta get out to California. And so I started working on the prototype for Dropbox, and I was trying to get into Y Combinator. And I would fly out and kind of.
You should tell them that you started it on the way to New York.
Well, yes. So New York does have a special place in our heart, or the Dropbox history, because it was actually born on the Chinatown bus from Boston to New York. So I don't know if any of you have had the pleasure of riding the Chinatown bus. I know some of the different companies are no longer around, so maybe this can't quite happen again, the Fenghua. But
it sounds like they've ridden the Chinatown bus.
But I was coming from Boston and visiting a bunch of my college friends, and they had, and I was like, if I take the bus, then I can get all this work done. So I go racing out to South Station, I get on the bus, and I open my laptop, and I realize I had forgotten my thumb drive. And this was like, yes, almost exactly 12 years ago. And so this was before the iPhone, and I can tell you the Chinatown bus did not have Wi-Fi. So suddenly I'm like, okay, not only am I not going to get any work done, but I have like nothing to do. I hate myself for forgetting my thumb drive. And so that's how everything got started 12 years ago. Is I just started writing code on the bus. But as far as trying to get into Y Combinator, then I think the summer before I would crash on I crashed on the Y Combinator dinners with Adam. And then
they have these weekly dinners where entrepreneurs all get together and a speaker comes in. And you were the overzealous person constantly talking and raising your hand.
Yeah, I was.
Drew was the guest. You're allowed to bring a guest to a YC dinner, and we never really had a formal rule about it until after Drew was the guest. Now there's this rule that when you come as a guest, you shouldn't be the one who asks the speaker all the questions. But when Drew came as the guest, none of the founders got a word in edgewise because Drew asked the speaker just dominated the Q&A afterwards.
So, I think these are all good stories of Drew being determined and resourceful, which brings me to my next point. Paul, over the summer, you gave a talk and you said something kind of surprising. You said, you don't need to be that smart or even creative to start a successful company. Drew, you're both of those things. So you're the outlier.
You're
you
creative
said you don't need
too.
to be both of those things. You actually just need to be determined. So is that really the key thing to get these billion-dollar businesses off the ground? It's just determination?
More than anything else, yeah. If you imagine, I think a New York audience will probably understand this, right? If you imagine someone who's 100 out of 100 in both intelligence and determination, right? And imagine you start taking away from one or the other, right? You have someone who's very intelligent and determined, and you start taking away determination, but still very intelligent. You don't have to take away that much determination before you have a sort of perpetual grad student, right? Whereas, you have someone who's super, super determined, and you start taking away brains, you can take away an amazing amount of brains and still make a lot of money. You just walk around the streets in this town and you can see examples. So it's true, isn't it, right? You know this. This isn't a fact about startups. This is a fact about business.
Yeah. So there's good advice for all of us in there. Just be determined, and we'll be on our way. So I want to go into nailing the idea, because clearly you guys have both had good ones over the years, but I think we all know ideas can be a bit overrated. Paul, you sum it up well. An idea doesn't need to be brilliant. Just look at something people are trying to do and figure out how to do it in a way that doesn't suck. I think it's pretty good advice. And then Drew, when you were starting Dropbox, I know some brutal press wrote, fortunately, the Dropbox founders are too stupid to know that everybody has already tried this idea. So given that, what do you think made Dropbox succeed initially, even though it had been tried before, there were naysayers, people didn't really get it? What was the X factor?
Well, I think first I would just start as a user of these things. And so I wasn't really, my objective was not to start a company, it was to not have to carry around a thumb drive. And so I tried all these different cloud storage things, and if any of them had really worked, I wouldn't be here right now. And what I found was so this was all very nascent, and it used to be very expensive to be able to store things in the cloud. And later founders would come talk to me. They go, I started whateverdrive.com, and do you know it cost me $1 million a terabyte to get started, and you guys are so lucky that the public cloud has been around, et cetera, et cetera. So I think a couple things. One, the user experience was broken, and the engineering was really hard to do. And so
Drew is being modest. What was different is Drew is a really, really good programmer. And making this kind of startup was actually really hard. And so there were a huge number of backup and syncing things. But the mere fact that there were a huge number was a sign of something. There's not, how many search engines are there now? Basically 3 as far as I know, right? And it's because Google is so good, right? No one in their right mind would try to start a search engine. But the fact that there were a ton of backup and syncing things was a sign for those who understood this that none of them worked, right? Dropbox had this remarkable novel feature in this world, this feature of working. Right? You would put your files in it and you would ask for them back and they'd be there, right? And it was because it was so hard, and Drew and Arash were really super good programmers. Well, you must have been among the best programmers in your year at MIT, don't you think?
We did our hiring through the MIT programming competition. Yeah, so Arash was one of the directors of the
Perfect
programming
SAT scores, let's not forget. So it sounds
we can go through the rest of my LinkedIn profile.
Yeah, let's go through the whole resume.
No, the reason that's not irrelevant is that before Dropbox, Drew started another startup to do SAT prep.
Which you
and
rejected.
he applied to Y Combinator, and we rejected them. And it was actually good for you that we did, because otherwise you would be like the king of SAT prep, and that would probably not be as big a kingdom, you know?
So, I mean, I think that's a good point. Paul, you have this knack for finding people who are really talented and just telling them that their ideas are terrible, and you've got a better one for them instead. So, like with
Yeah,
Airbnb,
the thing is, I'm often wrong.
Yeah, but like Airbnb, right? At first you tried to get them to do a different kind of company.
Yeah.
Thank God that they didn't listen, I guess.
Well, it's true. When Airbnb applied to Y Combinator, I admit, I tried to get them to change their idea.
To micropayments?
To micropayments. Just still a good idea. Business Insider needs micropayments.
Yeah, I guess, yeah, we do, actually.
So, but the thing that saved me, if you ever find yourself investing in startups very early on, the secret of investing in startups very early on is to go by the people and not the idea. The people, you know what they say about real estate: location, location, location. Well, because the location is the one thing you can't change, right? Well, in an early stage startup, it's founders, 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 because that's the one thing you can't change. You can change the idea. So we funded Airbnb thinking, well, I'm not so sure about this couch surfing thing, but the founders are great, and that's what we care about, so we'll fund them.
Yeah, but by the end, there's another hugely successful investor, Fred Wilson, and there's this great email exchange online of you sending 7 kind of somewhat annoying emails to Fred, being like,
you
must
should
invest,
see some of
must invest.
You should see some of my other emails. That was pretty mild.
But like, what was it about that idea that you knew could be big? You wrote at the time, there's no reason it couldn't be as big as eBay, and this is the right team to do it. So how do you know that when an idea is just so small?
I knew because they were getting growth, right? The users vote. The users know better than anybody else what they need. And so as long as you have user growth, that means you're making these people happy. You're doing something new, right? Same with Dropbox, right? It's users tell you if it's working.
Yeah, perfect.
Yeah, and I think focusing on growth, you can't really fake growth. I mean, you can have unsustainable growth, but like, I felt like in my first company, which I bootstrapped, it's very easy to get kind of in this kind of zombie mode where your startup is neither truly succeeding nor dying, which is actually worse than it failing. And so focusing on growth, which is really just a measure of like, do you have customers? Are they happy?
It's a way to keep yourself honest.
Yeah, that's one thing I've read that you say if you're going to focus on one thing when you're getting an idea off the ground, it's the growth rate because it compounds, right?
Like that whole thing with Gordon Gekko, right, where they were talking about like greed is good and stuff like that. I think one thing that got missed in that whole conversation, both sides of it, was that when people buy things, it's not just an exchange of money, it's an exchange of information. People tell you as a programmer what you should focus on by paying you or not paying you for things, you know? And it really keeps them honest too. Because people will often say stuff like, oh, you should build such and such. And you say, well, will you pay for it? And they're like, well, no. Right? So they don't really want it.
Right. Good sign. So one thing that you also say at Y Combinator, and Drew, you're a good example of this, is to do things that are unscalable at the beginning. What does that mean? That seems really counterintuitive. Don't you want to get as big as possible? Like, what is that?
Well, it doesn't mean that anything unscalable is a good idea. What it really means is that you should give yourself permission early on to do things that wouldn't scale. And usually that means things like paying an inordinate amount of attention to your individual users early on, right?
Yeah, in the beginning, we would have anything that went to support at, well, it was getdropbox.com because we didn't have dropbox.com. It's another story. But anytime a user emailed support at, and really any of the aliases like press at, we actually emailed the entire team for the first few years. So every problem that anyone on the internet had with the product would result in an email to everybody at the company. I mean, that's an example of something that doesn't scale. We had to stop doing that.
It's great customer service, but very hard to do that.
Yeah,
Once the company becomes huge.
For sure. And so you get that feedback loop much better than you do, or there's really no substitute for that kind of feedback loop. I mean, it doesn't scale, but you learn so much faster than if you didn't. And then it also applies to product development. So we built a Linux client, which, I mean, we love, I mean, we're all like big fans of open source and kind of came from that world to some extent. But that's not something that had like a big, no investor would look at that and think that's a good idea, but we knew that our early adopters, the people that would really love Dropbox and spread it, they would be massively happy with that. And that actually was a big differentiator in the early days, because then the early adopters spread Dropbox, because I saw how people did that with Google. Like Google they captured the hearts and minds of the early adopter community, and it spread from there. But as far as unscalable things, so a lot of the, I remember over the last 10 years, there's a bunch of examples of these AI startups who started by actually, who like making chatbots and things, who actually had humans responding to everything, or humans doing all the stuff. Because they're like, all right, if we can't actually make this work with like 5 customers and build like the best possible kind of white glove concierge service, like people are not going to want the worst version of that.
If nobody wants it with natural intelligence,
Yeah.
making the intelligence be artificial is not going to improve the situation.
Yeah.
No, totally not.
Yeah, the artificial intelligence.
Yeah. And I think the important thing too is that sometimes when you are just starting out and you're competing against all these big incumbents, they don't have the time and resources to put a lot of love into delighting users. And so there's a great Unscalable quote from you, Paul, in one of your essays where you said, it's not enough to do something extraordinary initially. You have to make an extraordinary effort initially. And to do something unscalably laborious to get started is so nearly universal that it might be a good idea to stop thinking of startup ideas as scalars. Instead, we should try and think of them as pairs of what you're going to build plus the unscalable things you're going to do initially to get it.
Yeah, in fact, for a startup idea, I've found if you're looking at a startup idea and you can't think of the unscalable thing that you would do to get it rolling initially, that's actually a bad sign.
All right. So I want to go into why big companies typically stink at innovation. And there's 3 reasons that I've found, but let me know if you think of more. One.
Now that you're a big company.
Yeah, and Drew can totally
Do you
speak to
stink at
this.
innovation now?
I hope not.
Well, so they've got turf to protect, right? So they've got innovator's dilemma. They're bogged down in layers and slow processes, and it's really not financially rewarding to employees the way that a startup might be. So I don't know, have you run into any of that as a big company, and what do you think?
How do you inoculate yourself against turning into a big company in the bad sense of the word?
How do you avoid it?
Yeah, well, I think, well, I mean, we started on the flip side of that, right? So we were going up against the Googles and the Microsofts, and kind of always living in fear of that. So you have an advantage as a startup where you can, I mean, your focus, your commitment, all that. Whereas our counterparts, like my counterpart would have been some product manager at some big company who's 9-to-5ing it and just doing this because it's their next promotion. And so the level of commitment is really different. And then on the flip side, yeah, as Paul mentioned, we're a 2,000-person company now. And you can sort of see how this starts to, because as you grow, you have to put a lot of the calories in the company go to just like making sure this big organism is working. And so you can
internal friction.
Yeah, and so I mean, at the same time, I think big companies can be really innovative, and I think you could argue that a lot of the big innovations and investments and advancements today are actually happening from larger companies, because you think about the big handful of internet companies, they've all read the innovator's dilemma, and they know how, and so they have a pretty good idea how not to be disrupted. They're run a lot more effectively. They're run by founders or people with a founder kind of mandate and mindset.
Do you still have a sort of programmer culture at Dropbox and not like a suit culture? That's one way,
Yeah.
right?
Yeah, we have a hack week. I mean, there's the window dressing stuff, but yeah, I think fundamentally we care about.
You still dress like a programmer.
So don't wear suits. That's basically.
I still code, yeah. I was, I think it's really important.
But like on turf, how do you know when to disrupt yourself? Like you actually almost missed out on Drew because you had a rule at Y Combinator about no single founders, right? And Drew
We
was
never had
founder.
any rule. We also had another rule, which is like no rule is absolute. You can have absolute moral rules, never betray people and stuff like that. But in ordinary pragmatic stuff, you don't want to have absolute rules. Not in startups, anyway.
Yeah. So you've got to learn to break your own rules sometimes.
Well, we told Drew, like, you're much more likely to be accepted if you get a co-founder. So Drew was very resourceful. He got a co-founder.
In 2 weeks.
Yeah.
So
Worked out really well, too.
Yeah, it's like the ultimate pairing in 2 weeks. It's amazing. So if you're running a big company, how do you remove layers and slow processes and increase your productivity? Like I know, Drew, you've got this thing where you're like, I don't do meetings on Wednesdays. What are some things that can kind of remove being bogged down?
Yeah, I think the first is to be aware of it. So you think about, and that sounds kind of obvious, but early on, someone I worked for, he's like, all right, how do projects slip like 2 years? Like, how does that happen? And the answer is like 1 day at a time. Often because you're not aware of all the little slowdowns. And I think when you're talking about bigger environments, often hierarchy means like you have to get all these approvals, and then you think about the life cycle of a product or decision, and like most of it, when you think about like going from idea to launch or to scale, that time spent is often not, the thing holding it up is not like, oh, it took this long to code it or to design it. The actual process of developing things is mostly consumed by waiting, because it's like, oh, we built this, but we got to wait for it to launch, or we got to wait for this approval.
So how do you avoid it?
So how do you focus on speed and cycle time? So you measure it.
So you're always standing there saying, come on,
Yeah.
what's slowing this down?
Yeah.
What's slowing this down, right?
And then as you're going on this journey from like engineer and startup founder, and like nothing happens except by your hands, to then you're leading and managing these teams, thinking of yourself less as like, oh, I'm the helper or player coach. Think of yourself like, how do you unblock things? Like, how do you help your team identify the limiting factors and like remove obstacles? So that's something we've increasingly paid a lot more attention to, because you wake up and, I mean, there are all these benefits of scale, but you have a much larger group of people to coordinate.
You know, that sounds, when he was saying that, I was thinking of Steve Jobs. Like, you know, come on, you guys, why can't you ship this thing?
Yeah.
Real artists ship.
Yeah.
You know?
Yeah.
So that's probably a good model.
So the one other thing I think is important is incentivizing employees. It's all about the team. Even from the beginning, it's about the team and the founders. You said like you can't replace them, but you can replace the idea. Even in big companies, there's all these talented people, but at a startup, you can get really rewarded for it. You can turn into Steve Ballmer if you're an employee at a startup that works out.
Do you want to do that?
It's not so bad to own a basketball team.
All right, sorry. That was just the first thought that popped into my head.
But so there's a lot of upside at a startup. It can be harder to reward people or even really measure individuals inside companies. And Paul, you've actually written that you think that's the single biggest problem afflicting large companies is the difficulty of assigning value to each person's work.
Yeah.
So how do you think about that? Like, what's the solution there? What are some ways to motivate?
Well, one possible solution, programmers, if you give them sufficient freedom, programmers will write code just for the love of writing code. I do it, you do it. Like the stuff you're writing now, I bet, like Drew still programs. I don't know if you guys, he mentioned that, but it's a really important thing. And you do it probably more than anything just because you like it and you don't want to just turn into a manager, right? And so I do it too. I write code all the time. And we do it because we love it. If you're a good programmer, a lot of programmers love programming. And so you can use that even in a big company, as long as you don't get in their way.
Well, and I think the startup risk-reward profile is you have to be comfortable with the most likely outcome, which is that your stock is worth nothing. And so I was involved in 5 startups before Dropbox, either as an intern or an engineer. And Dropbox is the second company I founded. And all literally, maybe 4 of the 6, it was worth, or my stock was worth nothing. Like the company folded. And you think of terms of expected value, like percent chance of having some kind of good outcome like this. Like a startup is not a good way to make money, like in expectation. And so I think that there's only so many. You have to like embrace that profile or like not have a lot to lose. I think that's why you have these founders who come out of school and don't have experience and are able to build these companies because they kind of don't know what's possible and they have nothing to lose.
And that lets them take risks.
Yeah.
And risk and reward are proportionate.
Yeah.
And then I think when you get bigger, you want to create that what you're really doing is managing a portfolio of bets. And so internally, we use different metaphors like for the different parts of our business. And so we have our seeds, which are these new ideas, concepts that we want to try, and the name of the game there is just like try a lot of them, and most of them aren't going to work out.
So you got to be willing to do things that fail.
Yeah.
And I think in big companies, failure is considered bad, right? Failure, that can't be good, right? But
yeah, so we create all these mechanisms.
if you're never failing, you're not taking enough
You're not
risk.
learning, yeah. And an experiment where you already know the answer is not an experiment. So, but you have to be much more explicit, and you have to plan for this. So we have seeds on the one hand, which are the early stage things. We have saplings, which are stuff we're trying to scale, trees, which are the core business, and then roots, which is the foundational stuff. But you need to have different subcultures for each of those, right? Like the roots, for example, which are like infrastructure and security. Like actually, those teams can't have a bad day, right?
Right.
Think about it. No, they can. Like that always has to work. And then if you go to the other extreme, with seeds, like no, actually every time these things don't work is like some valuable information, and you really want to focus on speed and things being half-baked and so
You
on.
have it extra hard because you have to do this. You have both of these in the same company.
Right.
You're like a medical device manufacturer almost. Some things have to absolutely work
Yeah.
all the time.
And everything
You can't
in
mess
between.
around.
And then we have, we're a public company. Like we got to deliver the goods every quarter, and so the trees have to be, even the core products have to have. We have to be really careful. I mean, we're holding on to, we're the stewards of people's most important information. So, but you have to create room in different subcultures to be able to adapt to the kind of problem that you're solving.
Okay. So we've got time for just one more quickie. You guys see a lot of founders come through the door. Well, a lot of people are working on. What do you think this next generation of entrepreneurs should be learning, and what should they be focusing on? Is computer science still going to be the thing? Should people be starting to learn biotech instead? Like, where do you think it's all heading?
Computer science is certainly necessary. I mean, you got to know how to program.
So if you had kids today, you'd tell them,
I have kids.
go be, oh, there you go. Go be computer science majors?
No, not necessarily computer science majors, but you have to know how to program.
Okay.
Yeah, I think it's the intersection. I mean, for sure, computer science, but I think that's pretty well understood that is super valuable. But I think it's the intersection of computer science and a lot of these disciplines that will probably be rewritten by computer science. Because in the early days, the internet or computing, like, we use that to like find information, and then software started eating other sectors like commerce. Now, as software, and when you've heard that phrase, software is eating the world. Like so many sectors are basically becoming technology sectors. And so when you think about what's the most exciting things happening in agriculture, like I'm sure there's a bunch of fundamental improvements happening there, but actually maybe it's the application of computer science, like the using machine learning to figure out where to plant your crops or how to optimize your yield. And so computer science is going to end up, and machine learning are going to end up rewriting how a lot of these other disciplines are done. And so if you and that's often where the lowest hanging fruit is, like when you take these two worlds that originally don't collide and put them together, most of the great discoveries and most of the low-hanging fruit is kind of on the margin between multiple disciplines.
All right. Well, thank you both so much.
Thank you.
Please welcome Sallie Krawcheck and Olivia Arand.
So I assume most of you in the audience know Sallie and know her background, but for those of you who don't, she spent years on Wall Street as CEO of Merrill's Wealth Management Division, Smith Barney, U.S. Trust, Citi Private Bank, and Sanford Bernstein. She was also the CFO of Citigroup. In 2016, she founded Ellevest, a digital investment firm for women. Thank you, Sallie.
Thank you.
So you've had a long career on Wall Street across multiple firms. And you've often talked about being the only woman in the room during your time in the financial industry when it really was the Wild West, and sexual harassment was, I don't know if it was the norm, but it was definitely more acceptable. Reflecting on your career, has anything really changed in the last 20 to 30 years when it comes to being a woman on Wall Street?
I have no idea. I really don't, because when I was younger, it was the Wild West, and there was almost sort of a sport of let's run the women out of the business. Today, I'm hopeful, or let's say if we had been together 18 months ago, I would have said, obviously it's changed. I want to be hopeful that it's changed, but with what's come out with Me Too and Time's Up, it hasn't changed as much as many of us thought that it had. And in fact, when we actually look at diversity on Wall Street, it's changed very little. There tends to be a tendency of let's hire individuals in at the lower levels, let's put together a diversity committee, and over time this is going to shift. But when I started on Wall Street more years ago than I care to share, my investment banking class was about 1/3 women. And every once in a while I'll now get a call from a reporter who'll say, guess what, newsflash, the investment banking class this year is 1/3 of 40% women. It hasn't been a pipeline issue in forever. It actually hasn't been a women leaving issue in a long time. It's been a women don't get promoted issue. And that, they just aren't making it. They start out in the funnel and they just don't make it through the funnel. And it's so bad that in the wake of the financial crisis, when I think all of us would agree, we hardly went into it as a diverse group that reflected, our culture, our country as it is today. So I like to say we went into the downturn white, male, and middle-aged, and rather than coming out more diverse, in the years after, we came out whiter, maler, and middle-ageder, which is not unusual for an industry that goes through crisis to contract in terms of diversity. But for the progress on diversity, you have to give Wall Street a D.
Would you want your daughter to work on Wall Street, knowing what you know now?
That is a great question. Happily, she does not want to work on Wall Street. And so I think it really depends on whether you get asked the question by a group of women or by a single woman. And if it's a group of women, yes, go, right? Because the industry needs you. The industry needs a freshness to it, an innovation to it. And every bit of research about diversity tells us that it's a positive, that diverse industries have higher returns and lower risk and greater client engagement and greater employee engagement and greater innovation, which is something I think the industry could really use, greater innovation. And so absolutely go, because the industry needs you, and the industry, in order to get to the next chapter and the next chapter, needs to reflect this country and needs to, in the wealth management industry, my old industry, reflect where the wealth is being built, right? And all the numbers around women and wealth tell us that we're seeing massive transfers of wealth to these women, in part because we live longer than you gentlemen do, and in part because we're graduating from college. 60% of college graduates are women. And so you want to say, for the health of the business, go. If, on the other hand, it's an individual woman, you sort of say, oh, okay, well, which part of Wall Street, right? Maybe you don't want to be the one who goes into the business that remains 90% men, right? Where you look up and you see no women in a vice president or a director or managing director level. Maybe you just don't want to fight that fight yourself.
Doesn't that perpetuate the problem, though, if there's not one woman who's willing to?
That's why. Well, there have been there have been one woman and one woman and one woman and one woman, but there is an issue of inertia, which is an object at rest stays at rest. And so if an industry isn't really committed to making a change, if everything else is more important, then to tell that one woman to go in is sort of to tell her to run into a buzzsaw.
So I was moderating a panel recently with a bunch of senior women in the hedge fund industry, and they were asked, how they managed to succeed in a boys' club. And their advice to aspiring hedge fund women in their 20s was to watch sports every day as a way of finding commonalities with men. I'm wondering what you think about that advice.
They really thought that was the answer? Oh, thank goodness, it's just that easy. No, what they're actually saying is pretty deep. What they're saying is conform to the industry as it is today, right? Assume this is a given, assume nothing is changing, and therefore find a way to make it as it is today rather than change it, right? Rather than bring your full self to work. Instead, find a sport or find something to connect with folks on. And look, this is what we see when you have few individuals of difference in and industry, they, it's hard for them to change the industry. You've seen the research. 1 woman on a board doesn't make a difference. 2 women on a board doesn't make a difference. When I was one of 2 women on a board, the 2 of us would studiously avoid each other so that it wasn't like the women were ganging up. Not that 2 could gang up on 13 or 14. It's only when you have 3, it's only when you have a critical mass that any change in any of that power of diversity begins to demonstrate itself. And so what I think they were saying in the hedge fund industry, 95% of hedge fund managers are men? What they're implicitly saying is you have to conform in order to be successful.
Is that the way forward?
No, of course it's not.
Yeah.
Right? And look, we saw it to some degree on Wall Street. A driver of the downturn that we never talk about, we talk about leverage and we talk about greed, but we never talk about groupthink. Right? The fact that if you step back, the industry, because it was homogenous, because so many individuals had similar backgrounds, thought the same, and there was no one coming in, whether it was amongst the regulators or the industry or the press, and said, how about these many different ideas? I call it, and I saw it at Citigroup, the false comfort of agreement, where you look at 3, possible scenarios, everybody agrees those are the 3, and you feel great because you know how to get through the 3, when in fact there were 10 possible scenarios, but because there wasn't enough cognitive diversity, that wasn't being taken into account. And so what really doesn't work in order to get the better returns driven by cognitive diversity is to bring in a bunch of women and tell them to act like men, to bring in a bunch of people of color and tell them to act like Caucasians, to bring in a bunch of introverts and tell them to act like extroverts. Taking a diverse group in and not being inclusive is a recipe for failure.
So we can't talk about women on Wall Street without mentioning the Me Too movement, as you mentioned earlier. In the course of my reporting, and there's actually a Bloomberg article about it today, I don't know if you've seen it, there's a lot of women on Wall Street who say in the last couple months since the Me Too movement took force, that there's men in their own firms that are scared about mentoring women. They don't want to take them out for drinks. They don't want to take them out for dinner. They're worried that their intentions will be misconstrued. Men, of course, who are looking to rise up, don't face these same problems. Wondering what you think about this.
Yeah, I'm going to try to be empathetic to this. Right? So here are these women, they're getting sexually harassed at work, and now we got to try to take care of the guys. Right? So, maybe it's a good thing that, men are feeling a little bit that sense of uncertainty, that sense of how do I act? Look, I remember in jobs that I was in at points in time of my career, I just felt like you felt like you couldn't say anything right? That by the very fact of who you were, of the body parts that you couldn't help to have been given, that whatever you did was a misstep. And so perhaps it's okay to have that sense of discomfort. What am I supposed to do? How do I find my way? Look, but it's interesting because if we go back to Wall Street, and I only, pick on the industry and call this out because it's an industry in which I built my career and one that I love. But, it's really interesting, guys, because for all the Time's Up and the Me Too movement is sweeping across this country, and for all that parts of Wall Street have been named by research at the top of the list or towards the top of the list for the incidence of sexual harassment, we actually have not seen Time's Up take root on Wall Street. Time's Up can't get the movement going here. And it's interesting to try to think about why. It's not because there shouldn't be one here, but it's, I've heard that it could be because of the non-disclosure agreements that have been signed. I think another reason for it is that women in this industry, unlike in other industries, compete against each other, right? If you're on a trading desk, she's on a trading desk, you're not collaborating, you're competing against each other for the same business. But it's fascinating that it really hasn't gotten going. And so what I would say to the men, who are feeling a little concerned about it is, remember 4th grade, right? Whatever you weren't allowed to do in 4th grade, don't do at work. You were not supposed to put your hands on someone, don't put your hands on someone, right? It's really just common sense. Anything you wouldn't want your wife or partner to see you do, don't do it. And then let's forge forward.
So switching gears a bit, a lot of big financial firms, whether it's BlackRock, whether it's Goldman Sachs, they say they're really technology companies. And I'm wondering, as a CEO now of a financial technology company, what big firms, I guess, in the financial services field do you look to for innovation?
None.
Yeah.
of them. Look, first of all, I think all of these businesses are technology companies, and I think for a long, long time, you know, it's been people and technology. And in some businesses, the people layer is thick and technology is light. In other businesses, the technology layer is thick and the people layer is right? And so you see it, you know, businesses that I used to have responsibility for, where the financial advisor, you know, used to, you know, sort of take the calculator, do the investment proposal themselves. That increasingly is being done by technology and is better done by technology. And so we're going to see that shift and move, and there'll always be room for people and for increasingly technology. If your job is, you know, on Wall Street to move this column of numbers over by that column of numbers, you better be looking to find yourself a different job. But look, what I think it is also is, you know, looking at problems in different ways. So if we look at the challenge of helping women invest. Women today keep 71 cents out of every dollar in cash, much more than men do. It cost women, it cost a young professional woman hundreds of thousands, for some of them millions of dollars over the course of her life, because she doesn't invest as much as a similarly situated man does. And for so long, the industry had initiative after initiative that was marketing to women. We defined the problem as marketing to women. We defined the problem as we got to make women change, right? But they're very problematic, those women, because as everybody knows, they're risk averse, except the research shows us that they're not. Everybody knows they're just not as good at math as the guys are, except the research says we're as good or better at math. Everybody knows women aren't great investors, except the research shows that women can be better investors than men by up to a percentage point a year. Right? Everybody knows women need more financial education. That's what's keeping us back. Except guys need more financial education too. And so the industry, perhaps driven by the fact that it itself is non-diverse, we're trying to change women and trying to market to women. We at Ellevest were really the first that said, by the way, maybe there's a product challenge. Maybe the product that Wall Street has put out for so long to individuals of outperforming the market and picking the ETF versus the mutual fund and having the star manager, maybe that's something that women don't find as appealing. Maybe, in fact, the industry, right, which is about alpha and beating the market, and CNBC is ESPN, and the industry symbol's a bull, which is a phallic symbol.
Investors, clients that are nervous about their portfolios.
Well, you know the answer to that. We're certainly not telling them to try to trade in and out and time it, right? And we're certainly not telling them to watch every bobble of it. The research is clear that what works, you know, nobody can call either the short term, the medium, for some folks the long term, you know. It's hard to call that direction of the market. And so what works is not trying to get every last bobble or even any of them. But to simply invest a bit out of every paycheck, invest that bonus when you get it, and then put it aside. And the worst thing you can do for an investment portfolio, particularly during periods like this, is look at it too much. But instead, there's research by one of the big investment firms that said that some of its best performing investment portfolios were those that had been abandoned, where individuals forgot about them. And so the right thing to do is just put that money in and let it ride.
Great advice.
Great, thank you.
Thanks so much.
Please welcome Steve Case and Rich Filoni.
Steve, thank you for being here.
Delighted. Good morning, everybody.
Morning. So, Steve, you have this thing, it's called The Rise of the Rest, and this is through your venture capital firm, Revolution. Can you just give us a quick summary of what this even is?
Well, it's funny to say it when you're in New York, but last year, 75% of venture capital in this country went to 3 states: California, New York, and Massachusetts, 75%. The other 47 states fight over 25%. And some of these are big states: Ohio, Pennsylvania, Michigan, Virginia, less than 1% each in terms of venture capital last year. So the Rise of the Rest is really trying to shine a spotlight on the cities that are rising as strong startup communities and on the companies that are emerging in those cities. And we launched about a year ago this Rise of the Rest seed fund with 40 or so of the most prominent entrepreneurs and investors, including Ray Dalio, who's joining us shortly, and Jeff Bezos and Howard Schultz and Eric Schmidt. Really, great group of folks who really believe that some of the great companies of the future will be coming from other parts of the country. And our strategy is to partner with the regional venture funds and help kind of back some of them. And you'll meet a couple of companies later.
And so how many cities have you been in at this point?
Well, we have done this Rise to the Rest tour for the last almost 5 years. We've done 8 tours. I think it's 38 cities, 10,000 miles by bus. So seeing all parts of the country, Albuquerque and Madison and New Orleans and Buffalo and Pittsburgh and Cincinnati, all over the country. And we are seeing remarkable things happening in those cities. The fund now is invested in about 100 companies in 50 cities in 35 states. And we've been pleased by the momentum we're seeing all across the country, which is not to say that New York here won't continue to be strong, or Silicon Valley obviously will continue to be the leader of the pack. Some interesting things happening in Boston, but we think it's critically important that we're backing entrepreneurs everywhere, creating jobs everywhere, so there's not a growing divide where some people feel like they're part of the innovation economy, a lot of people feel like they're left out. Plus, it's, we think, a great investment opportunity just as an arbitrage, because it's a classic supply and demand. When there's not much venture capital in these places in the middle of the country, valuation of those companies are lower, but when they're successful, a couple weeks ago, a company in Utah got acquired for $8 billion. 2 months ago, a company in Ann Arbor, Michigan got acquired for $3 billion. The exits, whether it be as M&A exits or IPO, the valuations essentially are retail, but right now in many of these cities, because there's not that much capital, the valuations at the seed stage and the venture stage are lower. So there's definitely an arbitrage that we're also trying to capture.
Yeah, and when you say that there's huge opportunity here, I was going to ask you, I mean, you've had a successful career. I feel like at this point in your career, there's a lot more easier things that you could be doing than traveling the country in a bus and trying to change the way that we invest in startups. So why are you doing this?
I think it's a great opportunity. And I think there's also, frankly, a little bit of an imperative, as I said before, to how do you kind of level the playing field. I felt when the early days of the internet, when we got started with AOL in 1985, only 3% of people were online. And those 3% were online on average 1 hour a week. And we said we want to get the world online, get America online. We thought it would be an empowering platform and help level the playing field in terms of access to information and education and commerce and all things, which obviously have happened. I felt proud of the role we and obviously many other companies played in taking the idea of the internet and making it a part of everyday life. I feel the same kind of passion and even a little bit of deja vu, because when I talk about the Rise of the Rest, people are skeptical, a little less now than maybe 5 years ago when we got started. You really think like in Indianapolis or Columbus or some of these cities, you're going to have like breakout multi-billion-dollar companies, and I explain why, but I can see the skepticism. Well, I saw that same skepticism 3 decades ago when we were talking about the internet. It was like, why do you really think people are going to like type messages to each other when like you could pick up the phone and call somebody? I mean, it seems silly now, but there was a lot of that. And so now that was about leveling the playing field in terms of access. This is about leveling the playing field in terms of opportunity. There are data points, just so you have them, beyond the 75% of capital going to 3 states. Last year, over 90% of venture capital went to men, less than 10% to women. Last year, less than 1% went to African Americans. So this is a great entrepreneurial nation. We should be proud of it. I am proud of it. But if you look at the data, it does matter where you live. It does matter what you look like. It does matter who you know. But if you have an idea, you really have a shot at building a company, really a shot at the American dream. And we need to change that. And the other data point that drives this passion is that most of the job creation in this country comes from startups, not from small business, not from big business, from young, high-growth startup businesses. And so if we're only backing those companies on the coast that are doing disruptive things that are destroying jobs in the middle of the country, and we don't offset that, at least in part, by backing the entrepreneurs in the middle of the country to create jobs in the middle of the country, the divide we already have is going to get worse. So it's both an opportunity as an investor and we think as an imperative as a nation.
Yeah. So Amazon spent over a year looking for its second headquarters. And for a while, it seemed as if it might go with one of these rising cities, a place like Columbus, Nashville, Pittsburgh. but they ended up going with New York City and outside of DC, much more established places. How did you feel when you heard that news?
Mixed. We started AOL in Northern Virginia, not too far from where their site in Northern Virginia. I think in terms of what's happening in that community, it's positive. I would have preferred if they had a second city, it'd be one of the other cities that were on their final 20. New York, as you all know, seems to be doing pretty well. But I think their point is a fair one, which is they were going where there was talent. And part of our challenge is backing these companies so there's less of a brain drain in these cities. What's happened for the last half century is people growing up in most parts of the country who are interested in technology, innovation, entrepreneurship, basically felt they had to leave. There was no opportunity there, so they had to leave. How do we slow that brain drain and create even a boomerang of talent? Because the talent is widely dispersed. I was speaking at a competitive conference, TechCrunch Disrupt, a couple months ago in Silicon Valley, maybe 1,000 people in the audience. I said, ask for a show of hands, how many people were from the Bay Area? Less than 5%. Everybody in Silicon Valley is from someplace else. They went there because that's where the opportunity was. So how do you shift that paradigm so there's opportunity everywhere? There's innovation, entrepreneurship everywhere. There's job creation everywhere, and that's we still have a lot of work to do there.
Yeah, and when you're creating these jobs through these nascent startup scenes, how is that going to offset when you have a company like General Motors and they decide that they're going to lay off 8,000 people in North America when they still have so much sway over these regions where these types of cities are? Like, are you even thinking of that? Like, where do these scenes fit in?
The nature of the business and innovation disruption is pretty clear. A couple data points. One is 200 years ago, over 90% of us worked on farms. Now it's less than 2%. Because technology made it easier to grow more food with fewer people. But we then followed that agricultural revolution with the industrial revolution, retrained people instead of working in factories, working in farms to work in factories. And basically it took a while. It was a couple decades of some churn and some turmoil and some frustration, but made that transition. And then when the industrial revolution was kind of peaking, we kind of made the transition. Haven't really completed that, but started making the transition to the technology world, the digital world. So this notion of job destruction is not new. The other data point is you look at the Fortune 500, it turns over every 25 years. About half of the companies are new every 25 years. So you've got to be backing the little startups today, some of which will be the big companies of tomorrow. And the nature of big companies, churning, being disrupted, again, you've seen that across all different sectors. So you have to have that as a backdrop. And then the question is, are you able to offset the jobs that are being lost by those big companies in some of the more traditional sectors? We in places like Michigan, we have I think 4 or 5 investments now. In Michigan, one we backed, it started with 3 people, now it's 300 people. I think they'll have 1,000 people by the end of the year. So there's tremendous momentum building in the downtown Detroit area. There's a lot of startups in the downtown Detroit area, and most people even 5 years ago had kind of given up Detroit for dead. Yeah. It was a powerful city, an innovative city 100 years ago, arguably kind of the Silicon Valley of its time 100 years ago, but then kind of lost 60% of its population, went bankrupt. Most people were giving up on it, but some entrepreneurs like Dan Gilbert and some strong leadership from the mayor and the governor and others, that city is rock back. The other point, I want just to go back to the Amazon point, is 236 cities applied, then 20 were picked as finalists, and then, as you said, 2 were selected. My hope for the other 234 is if they take half of the energy they put into making their Amazon bid, bringing their community together, creating a lot of collaboration with the university and the big businesses and the small business and the mayor's office, et cetera.
Because a lot of them went all out. Yeah.
Half of that energy, and if they took half of the dollars they're willing to put on the table to lure Amazon and refocus it on their startup community, they might create the next Amazon. So I think that's the opportunity here, not focused on the fact, oh, bummer, we lost, but how do we build on this momentum and take our city to the next level?
Yeah, and looking at the big picture of this, when we call these like rising cities, and that these are cities that are, maybe they were going through some difficult times in the past and now they're getting going again. How does building up like a startup scene, which is typically where you have people in the upper middle or upper class in terms of investors and entrepreneurs, how are you going to have that affect the entirety of the city, how does that lead to like a transformation?
Well, two
of
things.
cities from the
One is the companies we're backing through Rise of Rest to cut across all sectors. So it's not just focused on tech. We're doing a lot of different things in a lot of different sectors. And the company I mentioned in Detroit, for example, called StockX, it now has, I think, nearly 400 employees. A lot of them are working in jobs that are not like tech, kind of jobs. We also backed a company in Detroit called Shinola that basically retrains people who were building cars to build watches and other products. So that's one aspect to it. The other aspect to it is if you look at the data, for every startup job that's created, there's between 4 and 5 other jobs created in the community. It could be restaurants, could be dry cleaners, could be home builders. As people are moving to that city and they're part of the growth of that city, that creates a spin-off effect where there's other jobs well outside the tech sector.
Yeah, and I actually had a chance to join you on one of the Rise of the Rest bus tours. So everyone kind of went into this big red bus and toured around. We went to Louisville and Chattanooga, so I got to see those two.
And you get some great articles on it, so if you missed them, you should read Business Insider.
Thank you. Yeah, it's
archive.
This is a
Rise
plug.
of the Rest. Just trying to promote you. You hear that, Henry?
Yeah. Thank you. And something, so there was tremendous talent there, but something that everyone seemed to be very cognizant of is that these are scenes that are in their very early days. They're still building all of the processes and all of the networks. So when you're looking at people who are partners in your own fund or limited partners like Ray or Jeff Bezos, what are you saying? Like, how do you expect to get returns on something that is such a young?
Well, we think we'll generate great returns on these investments. We're backing great entrepreneurs, building great companies, just in places that nobody else is paying attention to. Yeah. But this also is some of these cities are building the next level, but all of them have an interesting history. Some were part of that agricultural revolution, some were part of the industrial revolution, some were part of the technology revolution. The first wave of the internet, companies like AOL, we were in Northern Virginia. Microsoft actually started in Albuquerque before moving to Seattle. IBM's PC operations were Boca Raton, Florida. Sprint was in Kansas City. Hayes, the modem company, was in Atlanta. CompuServe, a big competitor, was in Columbus, Ohio. It was actually fairly dispersed regionally. It was only the second wave of the internet, when it became about software and apps, that Silicon Valley really rose to such prominence, indeed dominance. So rebuilding some of these cities for this third wave, which is how the internet starts disrupting and changing healthcare and education, food, agriculture, sectors like that, we think it's a natural. And the expertise in some of the best research institutions around cancer, for example, are in Cleveland, the Cleveland Clinic, or in Minnesota with the Mayo Clinic, or in Maryland with Johns Hopkins, or in Texas with MD Anderson. The great expertise in terms of farming is a place like St. Louis, where Monsanto is headquartered, or Louisville, Kentucky, or Lincoln, Nebraska. They know a lot about farming. And so that domain expertise, we think, will be more important in this third wave. Partnerships will become more important in the third wave, and most of the big companies in those sectors are in the middle of the country. So we think there's a natural play here. We just need to spend more time identifying the entrepreneurs building great companies in these other places, and then do what we can to support them and support the startup communities that are on the process of rising.
Yeah, so it seems more like a natural evolution to you instead of a long shot.
Well, it goes back to what I said before with the internet. When I believed in the idea of the internet, and I even though for a decade it was a struggle and we almost didn't make it, I believed in the idea of the internet. I similarly believe in the idea of the rise of rest. I can't predict exactly how long it will take. I can't predict exactly which cities will rise faster. I can't predict exactly what entrepreneurs will have the breakout successes, the iconic, kind of multi-billion-dollar companies of the future. But I'm pretty confident over the next decade, people, including all of you, will be surprised that while San Francisco, New York, Boston, places like that will continue to be strong, there will be many other cities, including maybe where you grew up, including maybe where you went to school, that will be rising up and surprising us.
And just a real quick question. What was something that has been maybe surprising to you as you've toured the country and actually put this into action?
Well, one positive, one negative. The positive is we now, because we've been to a lot of different cities, I know it sounds like I'm just like drinking the Kool-Aid or selling the Kool-Aid, but it is remarkable what's happening. You saw that when you're in Louisville. Things are bubbling. There's still a lot of work to do on the capital. There's still a lot of work to do on the talent. Still a lot of work to do on a variety of different fronts, but it's bubbling. The part that is a negative that we're trying to focus on is these cities are much less collaborative than you'd expect. We have to figure out ways to connect people, and often are too cautious, a little risk averse, including often selling companies too early. Is they take, this company, somebody buys it offers to buy it for $100 million, they sell, but if they waited a couple of years, it might be $1 billion. So how do you create more of that fearlessness that is one of the great things of Silicon Valley?
Yeah, and we're actually going to have a couple of basically case studies for this rise of the rest theory. So first we're going to hear from Share, co-founders Ty and Courtney Caldwell. It's a Dallas-based company that connects salon owners to hairstylists to fill empty salon chairs on demand. So here is Ty and Courtney Caldwell.
Good morning. Good morning. We are so happy to be here at the 9th Annual Ignition Conference. We want to say a special thanks to Steve Case and our Rise of the Rest family for having us. My name is Dr. Ty Caldwell. Along with my beautiful wife and co-founder, Courtney, we are the creators of ShareShare. What is ShareShare? ShareShare is the first B2B mobile app that connects salon and barbershop owners to stylists to fill out their empty space by the day. So what we do is we allow people to rent that space, but at the end of the day, they're able to make money on that space as well. My quick background on myself. I've been in the beauty industry for 25 years. I've owned a successful award-winning salon for 2 decades. I wrote a best-selling book on how to maintain success in the beauty and style industry, and I've also earned my doctorate in professional barbering and cosmetology. Courtney, the rock star that she is, she's been in B2B technology marketing for 2 decades. She ran Oracle's digital demand generation, and she ran P&L over 5 continents. To be honest, ShareShare was just a problem we were just trying to solve for ourselves.
That's right.
Back in 2012, after expanding and rebranding our salon, we found that stylists wasn't looking to rent our space on long-term contracts. Instead, they wanted to rent by the day. So fast forward to manually matching stylists to empty space by the day for 3 years before finding a solution, couldn't find it, and deciding to build out the technology ourselves.
Yeah, that's right. So charting back to 2012, that's really when we started to notice a few macro trends that were starting to emerge in our industry. The most significant, though, was coming from the labor market itself. The majority of licensed stylists are now independent. Now, that's a shift that's been happening over the last 15 years or so. The self-employed are simply making the choice to build their businesses on their own. In a similar fashion, salon establishments have shifted as well. Today, the vast majority of workspace is what we call in the industry non-employer-based establishments, which simply means that these salons do not have payroll employees. So how do they fill the 40% of salon space that goes unused every day? Well, giving stylists the freedom to choose when and where they want to work actually becomes a win-win for both supply and demand. Stylists and barbers now expect the solopreneur experience, as we call it, where they can provide the best service to their book of business in an environment where they were classically trained. In this way, they can tailor fully the client experience. In their minds, it's about community over competition and access over ownership. At ShareShare, we're already ahead of this revolution. With 50% of the US workforce being a part of the on-demand and gig economy by 2020, we know that the future of beauty is owned by the independent stylist. In the same way that Uber and Lyft serve as that intermediary that sits in between the driver and the passenger, and today are completely revolutionizing an entire logistics and transportation industry, ShareShare will be that, but for beauty. And we believe that accessibility to tools that help maximize the earnings potential of every beauty and barbering professional should be affordable. That's why we built the first on-demand salon and barbershop space rental app. ShareShare sits at the very beginning of the stylist's life cycle and is the first global marketplace that allows licensed cosmetologists and barbers to rent space to work by the day. More than 400 cities and 11 countries later, we're now managing in excess of over $30 million in salon and barbershop workspace assets. And we're doing it all from Texas. Out of the 1.2 million licensed cosmetologists in the US, about 30% are actually from Texas. 4 of the 10 largest cities in the US also sit in Texas, and are within driving distance of each other. So it makes it super easy for stylists to build out their clientele in multiple cities. And when it comes to sourcing talent, there's definitely a beehive effect in Texas for biz dev and operations personnel. We may not be the first place you think about when you think about tech, but we definitely over-index when it comes to business development. So now is a very exciting time to be in beauty, and we're not the only ones taking note. There's a huge opportunity that lies at the intersection between beauty and tech. For example, Kim Kimble, celebrity hairstylist to Beyonce, Oprah Winfrey, Nicki Minaj, and a whole host of others, is one of the top innovators in our industry and is now a ShareShare advisor. TD Lowe of Fortify Ventures and Startup Grind is a respected change maker in tech. We are so thrilled to have these two powerhouses join us in leaving a lasting impact on our fellow stylists and owners alike. As the largest provider of on-demand salon and barbershop space rentals worldwide, ShareShare is the greatest engine of jobs and wealth creation for beauty and barbering professionals around the globe. Along with the support from our Rise of the Rest family, we are deconstructing an age-old industry in order to completely reshape it again for a changing workforce. Thank you.
Thank you, Courtney and Ty. So up next, we have someone who I actually met when I went on my trip to Chattanooga, and this is FreightWaves founder Craig Fuller. FreightWaves provides real-time freight data across America, has freight market projections, and it also has some original analysis. It does a lot. So here's Craig Fuller.
I'm excited to be here in New York. I met my wife here, so it's sort of homecoming to us. But my journey in FreightWaves actually started very early in my life. My father started what's now one of the largest trucking companies in the United States. I left that industry about 12 years ago and started a payments company and learned sort of fintech was going through this renaissance and how people make payments and deal with their money was going, a lot of investment capital was pouring into the industry. And so I got my exposure to an industry that was all about disintermediation and using technology to do so. These young, aggressive upstarts were displacing or potentially displacing the way that people get paid and trade stocks and stuff. I sold that business to US Bank, stayed on for 2 years, not really good employee, and decided I wanted to be an entrepreneur again. And one of the things I was doing was consulting with some of these digital apps that are trying to disintermediate the existing trucking marketplace. And the thing that they had in common for them is that they were trying to provide better transparency and information to freight market participants, knowing that we can track pizza, we can track Amazon goods, but it's very difficult to track trucks. But they kept focusing on transparency. And the idea that they were going to build up these digital marketplaces and disintermediate a very old industry was really core to their business model. But what occurred to me, coming from a family that is heavily invested in the industry, is what the participants really needed were better information. They needed to know what's happening in the market. There are 20,000 trucking companies that do more than $5 million in revenue. It's an industry with hundreds of thousands of participants. There's 16,000 freight brokers. It's a massive industry that touches every one of our lives. 70% of the US economy moves by trucks. And yet, the largest company is 2%. So they need information. No single entity has that information. So I got the idea that what has been done in the financial markets with companies like Bloomberg and Reuters could be done in the freight market. And that's how we started FreightWaves, was we've gone out and aggregated about $260 billion of freight transactions, and we provide editorial commentary and analytics for companies that move freight, that buy trucking services, and play as intermediaries in between. It's a massive opportunity. Now, the thing that we didn't appreciate, I love the irony or the significance of being at a digital media event was I never imagined that we would create a media news outlet. But we did that, and now we get about 2 million page views a month, and Meltwater says we get about 400 million impressions in a month. Our news site that's 18 months old gets about 2.5 times as much traffic each month as the largest news sites in freight. Some that are actually one of the oldest publications in America that's still around we get about 2.5 times the amount of traffic. And the reason we get that is because we are able to combine tribal knowledge that's authentic and backed up with data. Now, it was interesting when Steve came to town, to Chattanooga, I didn't have as much of an appreciation for what that would mean to our business. In Chattanooga, we started at Chattanooga, Steve likes to call it, and rightfully so, it's the Silicon Valley of trucking. It is a place that, as a epicenter, is doing a lot of innovation. But at times, Chattanooga sort of has envy when they look at Silicon Valley as the playbook and say, we need more consumer apps, or we need more sort of data businesses. And what Steve did for our business and what Rise of the Rest did for our business was it validated that an outside firm believed in the vision of focusing on what is organic to you. Yeah. And that was really what I think of all the things. We've had a lot of success. Business has been commercial for about 16 months, and we booked $2 million in revenue just last month, November, and that's up from about 500,000 in September and 0 in August of 2017. So we're fast growing. We're able to get venture capital. But what Steve did was quite different, and what Rise of the Rest did for us was quite different, is it validated to our own community about the importance of what we're doing and the fact that communities like Chattanooga should be doubling down on industries that it has a distinct advantage. And I think that's probably the most powerful part of it. The thing that I probably didn't appreciate at the time that I appreciate more is the fact that that was really that outside validation point. So excited to be here. So, thank you.
Thank you, Craig.
Many of the most compelling investment opportunities in the next decade will emerge from startups in cities all across America. Revolution's newest fund, the Rise of the Rest Seed Fund, brings together some of America's most iconic and successful entrepreneurs, executives, and investors to invest in startups outside of Silicon Valley and other traditional tech hubs. These Rise of the Rest entrepreneurs are a
place like Chattanooga or Dallas, but kind of key to all of this too is that you're pitching your region as well as your company. You have to kind of pitch this Rise of the Rest theory. So what are some of the challenges that you face being in these locations, and how are you navigating those?
I think for us, people think it's because it's the low cost of doing business. Chattanooga is a very efficient town to do business, cheap to hire, real estate all cheap. But that we have the benefit of being able to hire in any city in the world because we have the right model. For us, it's access to what I call tribal knowledge. You have this really deep organic knowledge base of how the industry really works. And technology itself, apps, we buy a lot of off-the-shelf. I mean, look, Mapbox is an example, and I'm not going to plug a specific company, but they have a really good mapping API, and so anybody can do that. And so the apps themselves that's not where the power is. The power is in the knowledge of how an industry operates and the community. And I think you talk about it in your third wave book, Steve, is the fact that there is partnerships that can be had by known quantities, and we're able to do that in Chattanooga. The challenge is, again, I referenced it earlier, is that I think cities themselves don't have a really good playbook. Chattanooga did not understand the power of doubling down on trucking, and I think Steve reminded it's an industry that we have a distinct advantage. And so I think that's probably the biggest struggle, was just that before Steve showed up in Chattanooga, FreightWaves and trucking was not a destination job per se, where now it is.
And are you seeing some of that in Dallas as well?
Dallas is different. I definitely think that the technology mindset is unlike Silicon Valley, but you definitely get engineers for cheaper, and you get your operations managers for cheaper as well. But one of the things about Dallas and the dynamic of it is that Dallas is very much a corporation state, or city and then state as well, because you have a lot of corporations that come there, which sometimes takes away from the entrepreneurial spirit, but at the same time, they still have it. So at the end of the day, once we realize that we can do something greater and bigger and bring our name to Texas, and also with the industry of beauty, we're one of the biggest states that actually lead the charge for the laws and the bylaws that go along with Texas. So it gives us the opportunity to not only change and educate people, but it gives us the opportunity to lead and give people more jobs and more opportunities in this business.
Yeah. And we've got time for a final question. Steve, so you're someone who has an amazing network of entrepreneurs and investors and even politicians, but how is this going to be a movement beyond yourself?
We have to get other people involved. We hope you'll consider expanding, irrespective of what you're doing, whether you're an investor or maybe you can be a mentor or a customer or just a champion or other entrepreneurs in other places doing different kinds of things. I think it's really important. There's some scary data out there that the Pew did some research recently that said 75% of Americans are anxious about the future, fearful about the future. The things that we celebrate when we talk about disruption, they view as likely bad for them, bad for their family, bad for their community, AI, robotics, things like that. We have to give everybody a reason to be optimistic about the future and feel like the future is something that will improve their lives, improve their communities. And it's not only about jobs, but jobs are super important. And so how do you make sure you're backing entrepreneurs everywhere who are creating that hope and opportunity everywhere, so more people in more places can feel like the future is something to look forward to. So it is an investment strategy, but it's also, as you say, more of a movement, educating people that there is opportunity, slowing that brain drain. I know some of you are from other places. You came here or some other city you flew in from because you didn't think there was opportunity where you were. You felt you had to go someplace else. How do we shift that narrative so there's opportunity everywhere and you can choose where you want to be and start and scale a company as opposed to feel like you have to go somewhere else?
Well, we'll be watching what happens next.
All right, thank you. Thank you all.
Thank you so much.
Please welcome Ray Dalio and Henry Blodget.
Thanks, everybody. You get a break after this. It's been a long period. So it's a huge pleasure and privilege to welcome Ray Dalio. Just to give you, if you don't know Ray, he has built over the course of his life the most successful and largest hedge fund in the world, Bridgewater Associates. He, a couple of years ago, became a best-selling author by writing a book called Principles, which is basically sharing with the rest of us how he did it. It's extraordinary. Ray is investing a huge amount in exploring the oceans. We're not going to talk about that today, but it's interesting. There's a Mars obsession going on right now in Silicon Valley and elsewhere, and Ray very articulately explained why Mars may be cool, but the oceans are super cool, and you're doing a lot of great explanation on that. And we will get to the markets and Bridgewater and what Ray thinks is going to happen. We're nearing the end of the cycle, and it's a little bit unnerving to the rest of us, but Ray, would love to just start at the beginning, which is you didn't just go to work at a pre-existing hedge fund. You started it. Can you tell us about that?
Well, I caddied when I was a kid. At 12, I caddied, and the stock market was hot at the time, so I would talk about stocks and I got hooked on the markets. And then when I got out of business school in 1973, I was in a position where I was hired director of commodities. I worked at company for about a year and a half, 2 years. I found out that wasn't for me, and I probably wasn't for them. And then I set up, people would pay me to trade the markets, and I had a 2-bedroom apartment, and I had a roommate who moved out of the other bedroom, and I started Bridgewater that way and continued on.
And that started well, but then you had something that you referred to now as the big mistake that changed everything.
Yeah, well, in the markets, you have successes and failures and so on. But so I started in 1975. Now, and 1980 or so, 5 years later, I had about, 8 or 10 people who worked for me, and I thought I had calculated that foreign banks had lent to emerging countries way more money than those countries would be able to pay back, and that we were going to have a debt crisis. And that got a lot of attention, and Mexico defaulted in August 1982, and a number of countries defaulted, and we had 250% of the debt outstanding, and I figured we were going to have an economic crisis, and I couldn't have been more wrong. I mean, that was the exact bottom in the stock market, because the Fed did certain things. And as a result, it was I had to let people go. I lost money for me. I lost money for others. I was so broke that I had to borrow $4,000 from my dad. And that was one of the best experiences, a terribly painful experience, but one of the best experiences that ever happened to my life, because it gave me the humility that I needed in order to balance with my audacity. In other words, I started to ask myself, how do I know I'm right? And that made me do a whole bunch of things that probably will take too long to explain, but I explain them in the book. And that change in mentality of how do I know I'm right? How do I find the smartest people I can who will disagree with me and understand things well? How do I diversify? How do I deal with those probabilities? Raised my chances of being right, raised Bridgewater's chances of being right, created a certain type of culture in which we bring independent decision-making makers in, and then we argue with each other and we go through certain protocols, idea of meritocracy, and that changed everything. That, you know, and it's the message that I would say. I convey a couple of messages to people. I would say, first of all, that like the best learning comes from failures. Best learning comes from mistakes. And so if you have a painful experience and you reflect well on it, that's the key, the quality of the reflection, you can learn principles that will help you do things better in the future. And the second thing I'd say is if people, when they're in situations, are successful or unsuccessful, if they write down the principle that they're operating in that type of situation, like a recipe, how would you handle that type of situation? You write it all down. That's, you know, that's good. And that's what the book is. It's just a collection of those.
And you describe it all in incredible detail in the book, and we'll talk about it in a second. But a few years ago, people started to hear stories about Bridgewater. And it sounded like this crazy place where all meetings are taped, and you can watch everybody speak, and everybody gets a score about how smart they are in certain areas, and credibility weighting. Have you been right in the past about this thing? And it sounded scary and stuff, and then you began to talk about it, and one of the things you said is, yeah, it's a tough environment. It is not for everybody, but it is what has allowed us to create this success. And so talk about
and I could describe it. It's what's allowed us to create this success. Bridgewater in one sentence is an idea meritocracy. In other words, the best idea wins out. An idea meritocracy in which the goals are meaningful work and meaningful relationships, to be excellent at both, and to do that through radical truthfulness and radical transparency. So, an idea meritocracy in which the goals are meaningful work and meaningful relationships through radical truthfulness and radical transparency. So the question is how we're going to be together. If we were business partners, and I consider all those people partners, can we get at the truth? And how do we get at the truth? Transparency is one of the most effective ways of getting at the truth. So what I did and what goes on there is that everybody pretty much gets to see everything so they could judge for themselves. And it's connected to the principles, and that there's disagreement, but there's that idea, the art of thoughtful disagreement and how that works. And there's no hiding the facts. We try to do it in a way which is very evidence-based. What are people's strengths and weaknesses? And we do, by assessing those in ways that are mutually agreed as being good ways of assessing that, by bringing all that to the surface, we learn people's strengths and weaknesses, which helps their personal development and helps to make a better decision-making process.
And it is presumably tough to be transparent.
It's tough only if, it's funny, people go through mental transitions about this. It's tough because of what they're used to, because of these ego barriers. In other words, how does it feel when you find out that you're not so good at something? Or how do you deal with disagreement rather than avoiding disagreement? Those things are tough in the beginning. Then what happens is, we call it sort of getting to the other side, then what happens is then people become so comfortable with that they can't go back to the other perspective. They can't go back to, okay, Henry, you wouldn't tell me what you think. Or I wouldn't know what my weaknesses are. As soon as people start to know what their weaknesses are and see how that's used to help them succeed, it becomes a very good thing. So everybody gets to know each other very well. So it's like a big family. You know how family is. And that becomes a dynamic. And a lot of these people, most of them who stay there, would find it very difficult to work into a company where they couldn't speak up, or it's all politics behind the scenes and nobody knows what's going on and what's truthful. Now, that transition doesn't work for everybody. So I'd say for something like a third of the population, they'll just, they'll say, hey, this isn't for me, I can't do this. And that's understandable. For the other 2/3 of the population or so, they couldn't be operating the way others operate in that political not knowing and not being able to challenge the leader that type of way.
And you talk about politics, and a lot of companies have reputations for being a lot of backstabbing and politics and people talking badly about each other. And actually, was interested to see recently, one of the principles is never say anything about anybody at the company that you wouldn't say to their face. And this is something that Netflix has been espousing for a long time too. Is that why you tape meetings, and is that what you...
Yeah, you can see anything firsthand, otherwise you get somebody's story, But can you imagine anybody in the company any day on almost everything can see the challenges, and that's good because it shows honesty. If you have transparency and then you're radically truthful, the transparency helps to reinforce the notion of your truthfulness, so it works that way, right? It works well. Now, that exposes them to the realism of running a business. We encounter, you do, a number of things that make that business very complicated to run, and people have an awareness. They don't have a naivete of opinion with everything being behind the scenes.
And you've said that your principles, and again, Ray has this great, very thick book that lays everything out called Principles and goes through all of it. You think they apply much more broadly than if I wanted to build a successful hedge fund, to life in general.
Let me emphasize that there's my principles and there's other people's principles. And everybody should pick the principles that they think is right for them. But in all relationships, we're dealing with the same things. Are we explicit in what matters to us and how we're going to be with each other? Is that written down in principles? So I would say for everybody to write them down. Then you ask the other question, do you want an idea meritocracy? Or do you want an autocracy or democracy? An autocracy. So there's a series of things here. Do you want to have an idea of meritocracy? How will we be with each other? Do you want to be radically truthful and transparent with each other, or do you not want to be radically truthful and transparent with each other? So these are are you going for the meaningful work and the meaningful relationships? The meaningful relationships, it's like maybe let's say a Navy SEALs or something. You're in the battle together. You're tough with each other, but you also have good relationships, uniquely good relationships. Do you want to have those things? Any relationships, any organization is going to have a culture. And so the question is how you define that culture. You could define it for yourself. It just has to be explicit. The reason there are so many of them is because I've encountered a number of things and they're very specific, and then we could debate them. Does it have a merit? And by the way, doing that has been why our investment performance has been great over these years, because what we would do is you'd write down that principle, and we then started also realizing that we could put those into algorithms to help the decision making. And so we could, by debating principles and knowing principles, that's so much better than making decisions on the fly. So I think it applies to all people or organizations.
So moving beyond principles, your second book, and I think you have 3 planned, which is great. The second book is about the debt cycle, which you say applies. We've talked about economic cycles here before. Tell us what that is and where are we in the debt cycle? When are we going to have the day of reckoning?
Yeah, the main thing I think for everybody is to try to agree on how reality works and having principles for dealing with that reality. And so the reason I wrote both of the books and the debt cycle book is if we could agree on how the credit machine works, how cycles work mechanically, and then think to ourselves, where are we in each of those cycles? And what are the cause-effect relationship? It gives people a way to approach things. It's like a doctor dealing with a disease. If you have to know how the machine works, the body, and then you know what to do about it. So that's why I wrote the book. And I think to oversimplify a bit, people's living standards over a period of time change primarily because of productivity growth. In other words, over a period of time, we learn how to do things better, and the output per man-hour improves. And that changes by couple of percent, and it wavers. And that around that, we have two big debt cycles. We have the short-term debt cycle, which we're used to, which we call the business cycle, and you have a recession. And when the economy's weak and in recessions, inflation pressures fall, central banks stimulate monetary policy, which they can do by one of two ways so far. They could do it by lowering interest rates, but when interest rates hit zero, then they have to print money and buy assets, and that's quantitative easing. So they stimulate, and then the economy picks up and so on. And as it gets later in a cycle, it starts to approach its constraints, and then the central banks tighten monetary policy. And there's a certain dynamic on that. And then that causes the cycles. We don't have much time, but let's say there's that short-term debt cycle. Over a longer period of time, there's a long-term debt cycle, which is essentially the accumulation of those cycles over time. And that's why they take place every, 75, almost long period of time. And that's noticed when you hit zero interest rates, when it's more difficult for the Federal Reserve or central banks to ease monetary policy. So in 2008, in much the same as from 1929 to 1932, those were the two times we hit zero interest rates. And the capacity of central banks to ease was reduced through interest rates. And so they printed a lot of money, and they bought those financial assets, which causes financial asset prices to rise, and they put that money out in the economy. And that, from 2008 until last year, was the nature of monetary policy. And as we start to approach the constraints in the cycle, they start to put on the brakes. Okay, now we get to the mechanics. So we're in about the seventh inning of the short-term debt cycle, I believe. In other words, they're tightening monetary policy. If they tighten faster than is discounted and so on, we have its issue. The asset prices are fully priced and so on. And we are at the end of later stages of a long-term debt cycle because the ability of central banks to ease monetary policy is limited. In the United States, we're close to 3%. You could go down to zero. And in Europe, you can't lower interest rates much. And in Japan, you can't lower interest rates much. And in those countries, you can't even print money and produce that. So that's where we are, I think, in the short-term and the long-term debt cycle. We have also a geopolitical cycle happening. The geopolitical cycle has to do with, traditionally, you have a war, and after a period of time, a war, you have a peace because you have a powerful country that is largely in control of that, and nobody wants to fight the powerful country, and so you have a peace. Then when you have the emergence of a competitive country in the form of like China is now emerging, you have that geopolitical issue. That's an important issue. That's why you see China and the Fed are driving the markets recently, right? The Saturday meeting on China, the Fed implications in the prior week with Powell and so on. So that exists. And then also very cyclical is that when you have a large wealth gap, and you have people disenchanted with the power of decision-making. Will government be effective, and we need somebody to take control of our well-being? You have populism. So the period we're in now looks very much like the late 30s period, in that for the rise, we have a limited ability to have monetary policy and so on. So I think that's where we are. And then, the implications of, is that right, and how do you play that?
All right, so you sound very reasonable and calm about that. I have to say you're kind of scaring the crap out of me, because here's what I hear. We're reaching the top of the short-term debt cycle, and it's floating on top of a long-term debt cycle. So wow, is the day of reckoning good. And we have this geopolitical problem, which is new emerging company, and everybody in the United States and around the world super pissed off because there's this massive wealth gap. It's just like the end of the 1930s, which was just before World War II. Ray, where are we headed?
I think it depends on how we are with each other. And I think that the greater risk, for all risks, is not looking at whether those risks exist or not. So in other words, you say I'm scaring the crap out of you. I think the question, just calmly, that we all should look at is first, is that true or not? Let's examine that together. Is it true or not? If we examine if it's true or not, at least can establish that, I think then you could take each one of those pieces and you could say, what would you do about each one of those pieces so that you can have a more prosperous environment? I think any one of those pieces can be managed well, but it's mechanics. And if you don't agree on what's true and how the machine works, then we're in trouble.
That is true. One thing that you and many other brilliant investors do so well is you don't ask, well, what should happen? You say, yeah, but what's going to happen? Let's be realistic. So I know what we should do, but what are we going to do? And just to put it out there, I mean, are we headed for a major market disaster across all assets and a huge world war?
I'm almost thinking it'd be fun to just say yes. And
there might be some tweets about
no, I don't want to do
Yeah.
that. Please don't quote me. No, I think the nature of the dynamic is more of a squeeze. This doesn't look like the 2008. In 2007, we would do financial statements of entities, and we could see that they would not be able to pay debt, and we were going to have a big debt crisis. Now it's not the same. It looks more like a squeeze, a big squeeze, because there's a certain amount of indebtedness, and where are we? And then we also have pension obligations and healthcare obligations, a lot of obligations relative to our needs, and we are borrowing a lot of money. The government is borrowing a lot of money, companies are borrowing a lot of money, particularly the government is borrowing a lot of money. So we have a situation which won't be, I don't believe, anywhere near as dramatic as something like 2008 in the financial crisis. I think it'll be, my own guess is that it would be a more gradual squeeze and so on. And then the question is, how does I think it'll have economic weakness consequences probably prior to the election, the next election, maybe yes, maybe no. That'll have an effect on probably that. And that same dynamic is happening around the world. So it looks to me like there'll be those squeezes. And then in the US-China relations and so on, it really depends on how that's approached. If it's approached in a very antagonistic way, mutually threatening way, I think that accelerates the probabilities and the timeline for different types of conflict, versus if it was dealt with in where a common risk of how you can have conflict. So I think a lot depends on how we deal with each other, and I think a lot of how we deal with each other depends on us calmly looking at this. Is that true? Does the machine work that way? And what do we do about that?
Ray, thank you so much. Always a pleasure to talk to you.
Thank you.
Thanks, everybody.
We will now be taking a short break. Programming will resume at 11:15 a.m. Ladies and gentlemen, please take your seats. The program will begin in 5 minutes. Ladies and gentlemen, please take your seats. The program is about to begin. Please welcome Wendy Clark and Tanya Dua.
All right, so since we're here to talk about the business of creativity and storytelling, we're going to kick off the session with 2 commercials, one from John Lewis and one from the International Red Cross, both by the same agency, Adam and Eve DDB, and both are holiday spots.
It's a little bit funny, this feeling inside. I'm not one of those who can easily hide. I don't have much money, but boy, if I did, I'd buy a big house where we both could live. If I was a sculptor, but then again, no, or a man who makes potions in a traveling shoe. I know it's not much, but it's the best I can do. My gift is my song, and this one's for you. And you can tell everybody this is your song. It may be quite simple, but now that it's done, I hope you don't mind, I hope you don't mind that I put down in the words how wonderful life is while you're in the world. All right.
Happy holiday.
So Wendy, to really
two very different takes on the holiday. And I think that's why I wanted to bring them. We're going to talk about models today, and anytime I do a talk about models, at the end, invariably someone comes up and goes, well, you didn't show any creative. So we're going to start with the creative.
So what are your takeaways for the audience? Two very compelling, powerful commercials.
I think today creativity has the broadest definition, and I think we have to have the dexterity as agencies to be able to do something as moving as the International Federation of Red Cross spot, to really arrest people and get you in the throat or in the heart, and for us to all realize that there's a non-commercialism to the holiday time too. And at the same time, be able to do something as beautiful as the Elton John spot for John Lewis, and again, organized around an idea that, you know, some gifts are more than just gifts. So I just love the almost the juxtaposition of the work, but from the same agency. So it shows you the depth and breadth of talent that we can attract now, and the way that we're taking that to the marketplace.
But do ads even work today? You keep hearing, you know, numerous kind of proclamations about how advertising is dead, agencies are being hit by, you know, a number of existential crises, the holding company model is unsustainable. Do you agree?
Well, I don't agree. I know that probably won't surprise anyone in the room, and hopefully many of our Fortune 500 clients, I don't think, agree also, because they employ us and they see the value of advertising. I think, Tanya, the definition of advertising in the traditional sense has changed. And so when we hear things like advertising's dead or it's dying or it's under pressure, yes, the traditional form of advertising that might have just been the 4 30-second spots that were in a traditional TV pod, I think that method now of simply thinking that you can do that, and it's a push model that we simply push a brand's messages out into the world and it will be so, I think that is dead. So I definitely think, you know, it's much more of a pull model now. The expansion of connection points, fundamental belief that just about everything communicates, right? And so we have to think about, and I think actually that's what's thrilling and attractive about the industry now, is the breadth of the canvas that you get to play on is unbelievable.
So since we're here to talk about new agency models, tell me about DDB Flex. Tell me what it is about, where the idea came from, and if you think that's the way forward.
Yeah, so I mean, what we're finding more and more, and to your point on the holding company models, is that we're doing more and more bespoke models based on our clients' businesses and in fact, the customers that they're trying to attract. So probably one of the best known ones is one we created for McDonald's in 2016. We are Unlimited, now over 2 years old, and so it's actually way more than a PowerPoint or a theory now. It's a proven model at 2 years old. 225 people working on, as we would say, from TV to Twitter to Trayliner. They do absolutely everything for McDonald's in the US, a fully integrated model with 6 different agencies all integrated together. That's the sort of spirit of what DDB Flex is, to your question, which is, it came from, quite frankly, the duration of my career has been on the client side, and my frustration that my agencies couldn't simply work together, that somehow, you know, it was about their ambitions or their brand instead of my brand that I was leading. I was thinking, well, how's that work where I'm paying all of you? And so we really created this model, which is about deep collaboration. It's about cross capabilities. It's about the talent you need where you need it. It really doesn't recognize geography. Geography is less and less important. It's about, you know, pulling in the talent that you need in just the increments and the timing that you need it. And so we are, you know, you and I had talked about, the word agency came from the term agent on behalf of. Our contracts for decades have been written as the agent on behalf of someone. Well, if we're the agent on behalf of these brands to face this very, very dynamic marketplace that is fluid and constantly changing, and 6,000 brand impressions on average for the average American, if that's our job to front that for the McDonald's and the State Farms and the Capital Ones of the world, then we have to be as fluid, dynamic, and flexible and nimble and agile as the marketplace represents itself today. And so, you know, the nice metaphor that I've been using lately that someone else in my company gave me was, you know, it's moving from oak trees to bamboo. And we want to be much more like bamboo now and less like this sort of staid oak tree. Those days are dead.
So you said it's a proven model. It's not just an experiment. Are there any numbers or anecdotes that you can share to prove that it's actually working?
Well, I think probably the best metric of it is that we keep getting more and more requests to do them. So we've now got McDonald's, which is We're Unlimited. We're doing one for Johnson & Johnson, which is Velocity, which is now a year old. We just won the Volkswagen pitch in EMEA and Latin America, and we're setting up a bespoke agency for them called Voltage. We also work for SEAT, and we have a bespoke agency in Barcelona. And so those models, and they're all different. Like if you went and looked and inspected each model, because all those companies are different, from a car company to a quick service company to the FMCG company, they have the customer mandate to those brands is different. So they're built on, and this is what probably the most arresting moment in the McDonald's pitch was when we said, we're not going to build an agency for you, we're building an agency for the customers you want to attract to your restaurants. And we use that North Star constantly in these models. Like, what does the consumer want? What is the customer you're trying to recruit and retain and drive frequency with, no matter what your product is? And that then, so that would be probably the best indicator. And we're also doing one for Unilever. Actually, I have a pitch today for Unilever for a bespoke model. So again, the very big leading brands are all looking at these models now, which tells you, listen, the three mandates of the marketplace: growth, speed, and efficiency. So every client we have talks to us about those three things. And so integrating these models gets you speed and it gets you efficiency. And if we do our job, then you'll get growth. And so you can see how clients end up looking for these evolved models.
So agencies have started thinking about growth, speed, and efficiency, but there's another group on the block, consulting firms, that also talk about it and claim they can do it better than ad agencies. Do you regard them as a threat at all?
I don't regard them as a threat. I regard them as a worthy competitor. And I, for one, like competition. I think, categories and industries that have great competition are thriving categories and industries. And so I want new competitors and new talent to come into our business, because I think that means there'll be an all boats rise. So I welcome it. I think, again, it will create us ultimately being better as an industry, and that's good for everyone. So.
All right, let's turn the attention to you. So you were appointed global CEO of DDB earlier this year. What has been top of your agenda?
Well, we have 200 offices in 100 countries. We have 12,000 people around the world. So top of my agenda was to get to know the region I didn't know. I was leading North America before I took this job. And so I knew North America pretty well, but I needed to get out in the world. And I have been on a plane pretty much nonstop. Every single week I'm on a plane somewhere. And that's part of the role and part of the job. But this is a 68-year-old venerable brand. The B in DDB is Bill Bernbach, who's widely considered one of the forefathers of the practice of advertising. And I take that responsibility very, very seriously. Before this, I worked at Coke, so I know a thing or two about the iconicity of a brand and the importance of legacy and history. And I wanted to honor that first and foremost, coming into this, and learn and understand what DDB people were doing around the world. But we're moving very quickly in division setting. We'll have our first global conference in March with our top 300 leaders coming in, where we'll set the agenda and the vision for the next 3 years. And so between listening and then organizing for the vision setting, that's sort of taken up a lot of my first 8 months.
In terms of passion projects, I know you're very passionate about diversity as well as lifting women up as you rise. How has that been going? Do you think advertising, broadly, the society, but advertising in particular, do you think it has had its moment of reckoning?
Well, we were talking about this a little bit upstairs. I'm not quite positive there's going to be sort of one tipping point. I believe every single day we're working harder, we're driving more outcomes. The thing I think as an industry, I'll speak for advertising specifically, what we've got to move into now is away from a narrative and into actions and into accountability. And you and I were talking about, so far in the first 10 months of this year, we've placed 30 women into executive roles in DDB worldwide out of about 52 roles. So we are indexing significantly higher than the representation of women in leadership roles. And those are just, I think that that's a requirement. When I was at Coke, I led the Women's Leadership Council there. In the 6 years that we had the council before I left, we moved from 18% representation in senior leadership to 32%. It is entirely possible to move this, but you have to measure things, you have to inspect really closely, and you have to drive, accountable outcomes and hold everyone accountable. So.
But progress isn't linear, right? There's setbacks along the way. Just last month, DDB had a setback where, for context, they hired a freelancer that was terminated from his previous role due to workplace culture. What are your learnings from that? How are you moving forward? How would you have done things differently?
Well, I think I always talk about I'm not a perfect leader. I don't lead a perfect organization. And I don't want our organization to ever think that failure is something to be hidden. And so part of our commitment has to be always learning from failure. And it is genuinely the case that, if you knew then what you know now, you'd make decisions differently, right? That's genuinely what you learn from making mistakes. But what we can't do is be afraid of failing. We have to be able to have a learning culture where we share how we arrived at a wrong decision or how we failed, and then make sure that we're moving forward. And that's something I've faced the agency and talked about. And I think that's really important that they see me in a moment where I made a decision that was not the right decision, own that, and we move forward together. In the macro sense, I think setbacks set you up for the next comeback. So they'll never be a perfect journey. I've worked for 27 years. I haven't had a perfect career, but I think it's about the learning you garner and that you sort of move that forward and bring everyone with you, to your point. It's very much, to your point on the mantra I've carried for a long time is lift as you climb. That doesn't intimidate them and that you're very open. And that probably goes all the way back to my very first job out of college. I was a receptionist in an ad agency. I wanted to be in advertising. It was 1991. I couldn't get a job. And there was a posting for a receptionist job. And I knew that if I could just get my foot in the door, I felt like I could work my way up. And so I have a great amount of understanding of never being above doing anything. There were people when I was a receptionist who didn't treat me very nicely all the time and belittled me or thought less of me, and they had no clue what my story was, what my journey was, and I have never, ever forgotten that. So what I talk to young people about particularly is never be above doing anything, right? We'll be doing a pitch, I'll go do the coffee run, it doesn't matter. It's whatever role you can do to contribute to an organization's ultimate success, that's what you should do, and hopefully my leadership style exhibits that today.
So being a high-flying executive, particularly in advertising, isn't easy. As you said, you're always in a flight. There's a lot of sacrifices you make, a lot of time commitment. Do you ever feel guilt as a mother of three?
Well, of course you do. I'm a mother of three. And again, upstairs we were talking about that voice, that Debbie Downer in your head never goes away. And what I say is you got to shut that bitch up. And so, honestly, but I talk to the young people in my organization. I'm like, you think I don't have her? She's still there. Age has given me the ability to control her more. But that voice, that doubting voice, or that guilt voice as a mother, are you there enough? Are you? But my kids and my husband are fantastic. I've always worked, and so it's not like I was home for a portion of time and then everything changed. They have grown up this way, and we have a lot of fun things that we do. Obviously technology allows you to show outside your hotel room wherever you are, and I bring currency back from wherever I go, and chocolate always wins. All variety of different chocolates. So again, I think making it part of your kids' lives instead of this is my life and I'm not sure what you're doing, but we all do it together, either virtually or specifically. They were with me in London a couple of weeks ago. That's what we try and do.
All right, to wrap things up, if your two daughters or son came up to you and said, Mom, we want to be in advertising, what would A, your reaction be? And two, 3 things that you would tell them they really need to have in terms of a skill set.
Well, I would be thrilled. I love this industry. Getting to work on things like you just saw, creativity is absolutely my motivator. And actually, I've got 2 fairly artistic, 2 of my 3 are quite artistic, so I keep maybe you should come hang out with mom. I'm not that cool, right? But I would love them to go into, well, honestly, whatever they want to do, but if they want to. And what I would say is, look, the one I already said, never be above doing anything, I think is really important. The other thing I'd say is never believe your own press. When I was about 26, a mentor of mine said, people can say a lot of nice things about you, and if you believe them, you'll stop trying as hard. Never believe your own press. And then, you know, ultimately it's the golden rule. I've always tried to treat people how I'd like to be treated, and I think I've raised my children that way. I hope that they will carry that in their careers, but you find if you just treat people the way you want to be treated, it's remarkable what can happen.
Thank you so much for your time, Wendy. It was a pleasure having you here.
Please welcome Darren Laybourne and Gordon Krovitz with Henry Blodget.
Thanks again. All right, everybody, we have a serious fake news problem. And this is not the fake news that our president often rages about, which is news that is factual that I don't like. This is actual fake news. Fake facts, propaganda designed to sway us, designed to allow the proponents of each political team to score points against the other team. It is destroying many of our big news distribution platforms. Some of the best brains in the world have tried to solve the problem and failed. These two gentlemen are solving it. Darren Laybourne, the head of Microsoft News. Microsoft News, we work with many, many platforms to distribute our news. Microsoft is hands down the most successful and best from many perspectives in terms of getting great stuff in front of the news readers of the world, and in terms of making it possible for journalists to eat, which is not a priority at some other platforms. Darren's going to explain how he does that. Gordon Krovitz, the former publisher of the Wall Street Journal and a longtime board member of Business Insider, thank you very much, has a new company called NewsGuard that is effectively playing the role of saying, look, this is a real news organization, fact-based. This is not, and Gordon will tell us all about that. Gordon, why don't you start? What is NewsGuard?
Terrific, Henry. Thank you very much. So when we started the company, we said we were going to try to counter fake news. That phrase, as you say, got kind of appropriated. So we say we're fighting false information, misinformation, and disinformation, and we're doing it with journalists. We have 30 journalists. They have rated and done what we call a nutrition label write-up on all of the news and information websites that account for 98% of engagement in the US. We have 9 criteria. They're journalistic criteria. They have to do with credibility and transparency. If any publisher fails on any of our 9 criteria, somebody actually calls them for comment to ask, you know, what's going on here? Why don't you have a corrections policy? Or why do you continuously publish false information? Algorithms, you know, don't call for comment. That's a journalistic kind of thing. And our business model is we hope that the social media companies and search companies will license these green and red ratings and make them available to people in their Facebook news feed or in their YouTube search so that they have some idea of the source of news that they're seeing on the internet. You know, some of the people in this room are old enough to remember you'd go to a newsstand and you would say, I'd like the Philadelphia Inquirer, I don't want National Enquirer. Right? One's a city newspaper and one's a gossip newspaper. On the internet, everything kind of looks the same. And it's super hard for regular people to know, is this a trustworthy source or is it not? There are exceptions, and we'll talk about MSN in a moment. But generally, for the social media companies and the search engines, it's all one giant uncertainty. Opinion polls say that about 80% of Americans feel anxious about news. What can they rely on and what can't they? So to illustrate this, I have a couple of slides. It's been a long morning. Some of you may be thinking about lunch already. Let's say, can I eat that salad? So you do a search here on Bing, can I eat romaine lettuce? And you see some sources here. This is our browser extension version, by the way, which was sponsored by Microsoft. Thank you, Darren. And available on libraries or free to any of you who would like to download it. And so you see some sources here that are rated green. You say, I'll check out this one. This looks like a pretty good source. That's the local TV operation in the Triangle of North Carolina. It gets 8 of the 9 criteria are fine. It doesn't have a good corrections policy, but it's generally trustworthy. That's great. Or maybe you say, let me check out Wikipedia, and the Wikipedia entry actually says this is a great source of information, but be aware that in certain categories, especially, by the way, false information, false news, it can be played by bad actors, so just be careful. So let's say a different kind of search. Some of you may remember the New York Times story a couple of weeks ago about Facebook having hired a group called Definers Public Affairs to do opposition research on competitors and George Soros and people like that. Well, here there's a search. You see a red icon. This is for NTK Network. This actually is operated by Definers Public Affairs. It looks like a news site. NTK means need to know. Here's what you actually need to know. It's run by Public Affairs for its clients, and it publishes information favorable to its clients and negative about everybody else. Let's say you wanted to read the full nutrition label. There's a long explanation of why you should be awfully careful about reading NTK Network news. There are happier stories if you are interested in getting your news from MSN. You can see here it is rated green and has a perfect record. And Henry, I know you've been waiting, wondering, Business Insider, thank goodness, gets a perfect rating from us. So that's
we got a call from one of your people once. It scared the bejesus out of us.
Yes, I think there was one of the criterion where it wasn't quite as good as we thought it might be, but that is what happened.
We fixed it instantly.
Yes. Game our system.
Yeah, exactly.
Please.
Darren, tell us about Microsoft News.
So Microsoft News is the news distributor. We distribute trusted news and high-quality news from popular publishers, and we work with 4,500 publishers right now around the world to distribute that news. We distribute it across Microsoft products and a growing number of syndication partners. And today we're getting about 500 million people a month come and read the news from Microsoft News, which is a pretty big number, which is kind of nice. We're doing it in 140 countries, and we're doing 28 different languages, which is a pretty big operation.
Tremendous. So it's curated. You have a team.
Yeah, I've got a team of 800 people that are around the world doing their editors, former journalists, who are curating the news. And so they're picking what's there. Now, because we get so much news, we get about 170,000 pieces of content, which is a really large amount of content. And so we use, kind of a combination of art and science to pull off what we're doing to protect people. First we sign a contract with all these partners, and so we're looking at them to make sure that we think they're producing high-quality content and that they're delivering what we want to our customers. Once we've got that, we get that content in, we run these algorithms on it to make sure that we're getting all the right stuff in. If we're not, we give feedback back to our partners saying, hey, you're not quite hitting the bar right here. Then we take those people, we curate the news, make it available, and then because we've got data coming from so many different organizations, we can create what we call perspectives, which gives you multiple perspectives on a single story. So we can have 7 or 8 different stories all written by different journalists telling you what they think happened, and you can get all those perspectives at one time.
And so your model, it is curation, as you've described. There are others that do this. Apple News does this. They have a very popular, especially on the iPhone's news section. One big difference between Apple and Microsoft, though, is that you are, as I mentioned in the beginning, solving what I would describe as the journalists also need to eat problem, which is you are passing a lot of money back to publishers.
Yeah, I think we're doing a really good job. I really like the approach we've taken. And so we've created a partnership with each person. We do a kind of a hybrid model where we monetize the content and we also pass back traffic. So there's a combination of both of those things that you get back as a publisher. We've done a really good job. Over the last 4 years, we've given back $700 billion in revenue to publishers directly, which is a large amount. It's something that I worry about every night is, have I created a good partnership between our team and the publisher team? Because we've evolved to a model now where we have no content of our own. We just distribute the news from other people. And we want to make sure that deal that we have is great, because if it's not, we won't have a product anymore.
And you rely, as you say, on journalists and editors to select credible news organizations. You're not deeply fact-checking any particular article. You're saying that is the issue of the news organization. Of course, you're not going to jeopardize your reputation by doing a shoddy job and so forth. So as I mentioned in the beginning, There are a lot of big brains at other companies focused on trying to do what you do with algorithms. And yet, over many years, I really believe the other platforms, they mean well. They're trying to solve this issue. They cannot. Why not? Why is it, Gordon, that we can't use things like the number of shares on an article to tell us that that is the most valuable of the articles?
Right, so imagine if you were a teenager in Macedonia looking to make, $10,000 a month, $20,000 a month. One of the easiest ways now is by coming up with a fake website, publish crazy articles, monetize it through programmatic advertising. Remember, with programmatic advertising, the advertiser doesn't really care what the site is, it's following individuals. And so if it happens to be at NTK Network or the Denver Guardian, some of you may remember that as a fake news site around the 2016 election, it looks just like the Denver Post. It has great navigation that quotes people, everything to a machine, which is what artificial intelligence is. Everything to a machine would say, this looks just like a real news organization. And in fact, at NewsGuard, what we essentially do is we check out the bona fides of all of these websites. We've tried to figure out who really owns them. What are their standards? Do they actually ever post a correction? Turns out, by the way, to be a great indicator of whether it's a fake news operation or not. Machines really cannot do that. And we have to call almost all of the websites that we have reviewed because they fail on one of those 9 criteria or another. A machine is definitely not going to do that. So I think part of the problem is every one of these platforms has got a different culture. And the culture for some of them, I would say especially the newer ones, is a very engineering-focused culture where surely every problem could get solved by a machine. Well, in some cases, human intelligence, at least at this stage of the world, is more effective and efficient than artificial intelligence. You get false positives with artificial intelligence. It's very hard to tell the difference between the Denver Guardian and the Denver Post, or the Need to Know Network and something else. Some companies, like Microsoft, I believe, have got a different culture. They think about the problem differently. They understand that human curation is going to lead to a safer, better, well-lit experience for their users. I think the other companies are going to come around to it because I think even now, by now it's clear, even to those very technology-focused companies, engineering-focused companies, that there are some problems that artificial intelligence can't solve. And by the way, maybe they should not be the ones to try to solve it anyway. People do not trust some of those platforms to make judgments about news. They don't necessarily even trust independent journalists like NewsGuard. So we operate with radical transparency. I think Ray Dalio would be happy with how we operate. You can see exactly what the criteria are. If a publisher complains, we post the complaint, all sorts of information about it to try to build trust. But at least in this case, we're journalists applying journalistic criteria to journalistic entities. That's very different than a technology company trying to write an algorithm based on engineering notions about what news is.
And it really is. I mean, the incredibly smart people have tried to approach the algorithm. And what one of the platforms will say after this many year experiment is, well, what we didn't realize was when something fake arrives in front of you that confirms something you believe, want to believe, and want other people to believe, you just say, like and share. Because yes, that's what everybody believes. So if the news happens to be Hillary Clinton, scientifically determined to be part lizard or what have you, boom, off it goes. It's right at the top of the charts. Wow, that's a great article. Darren, you still, with your curators, must get the other problem, which is, hey, I don't like that picture of our president because it makes him look crazy. Complain, shouldn't this person be stripped out or this news provider be stripped out? Like, how do you deal with that?
You're reading my email?
Yeah. If that's all you're getting.
What's interesting for us is we get more complaints from inside Microsoft and inside of our team than we get from the outside world. And so there's there's a bar that people are trying to hold, which we want to hold a really high bar, and we want to do a good job. And so there's constantly in there where we're getting that pushback and we're trying to do good work. We're actually combining the technology. So we do use AI. We do use technology to write stuff, and so we're trying to say, what can we do to make our people more productive? And have the people also look at the algorithm and give feedback to the algorithm and say, oh, you don't have it right, this isn't right. I know you think you wrote it right, but you didn't get it right. These 3 things were incorrect. You should have done this differently. So we kind of have that cycle that goes back and forth between our teams. But we make our people more productive with the technology that we're using.
And how do you think about, like one of the things that journalists love to do, when there's a news event, which now many times a day, there's a huge news event, often coming out of Washington, that captivates a lot of the news generating industry. And one fun thing that journalists do on Twitter is they take screenshots of all the major networks, and usually, or often, several of the major networks are talking about the same shocking thing that has been said, and then the other network is talking about Hillary Clinton's emails, still, today. How do you deal with that? Like, how do you serve the people who watch both of those networks without putting yourself in either camp or being a source where you yourselves get lambasted for partisanship?
Well, we try to have partnerships with all of them, and then we make all of it available. And part of what we want to have happen is that people can see different perspectives and not just get stuck into one. And so we don't allow you to dig yourself into a hole just to focus on the one spot. And so while you can't turn your TV channel to one, when you're looking at Microsoft News, you're getting a diverse set of perspectives back.
But then what is the criteria for an organization that might appear from the outside to have a political viewpoint? Do you allow some of that?
Yeah, you have to allow some of that because there's some truth and facts in.
And is that the same, Gordon? Is that
Sure. I think really the most important thing is that readers know what they're getting. You know, my teenage son came to me last summer and he said, "Dad, what's this Vox website? You know, it looks really good, but it seems kind of left-wing. What is it?" And that's one of the problems that NewsGuard addresses, not with the green and red. You can be right-wing or left-wing, it doesn't really matter. It's the standard of the journalism. But the write-ups indicate, by quoting Vox in that case, what their general orientation is, so that people have some idea when they're watching that network that you're not mentioning by name. I think it might be Fox. Or if you're reading Vox, that at least you have some sense of where it comes from. In the Fox write-up, we quote Rupert Murdoch as saying he started Fox News because he thought that he saw a vacuum of non-liberal outlets. And so if you're looking at Fox, you're getting a very particular point of view. So we think disclosure and transparency and giving readers more context so that they can make up their minds about what they want to trust, that's really the American way. We don't think censorship should happen. And you know, there is censorship that happens at some of the Silicon Valley companies. They don't really have a tool other than censorship right now. We think the better tool is arm your users with information so they can make up their own mind. You gave the example of, you know, people sharing sharing, you know, false information, and people do love to share false information. There's been some very good independent research that says, you know what, if there's a little red icon by the source of that information, and it says this is not a generally reliable source, people are much less likely to share it. People don't want to look like idiots. And if any of you has got a crazy Uncle Frank, you know, who shares crazy stuff all the time, having a red icon by the crazy stuff, the data say, will dissuade him from sharing so much, and you'll have a happier Thanksgiving.
And so this is a critical point, which is that both of you are looking at the spectrum of news and information that's out there and saying, look, you can be somewhere on a political spectrum, but still be fact-based and still care about getting it right, so forth. Still spectrum, we can all choose who we listen to. Then outside of that, you've got folks who maybe are so motivated by politics that facts don't matter and so forth. One of the reasons other platform companies have had trouble figuring out this issue is there is a big devotion to libertarianism, citizen journalism, skepticism of authority, these news organizations. We want anybody to be able to produce journalism. I mean, isn't that a good ideal?
You know, I don't tell anybody, but I'm sort of a closet libertarian myself. And
I know that.
Really empathize with that point of view. But the right way to think about that is give people information about the sources that they're looking at. And if it's a crazy thing that doesn't follow journalistic principles, it's probably not going to be a super safe source. One of the relatively few sources, other than Business Insider and MSN, that got a perfect green from NewsGuard is the Daily Signal, which is the website of the Heritage Foundation, a very conservative think tank. When they set out to create the Daily Signal, they actually did some consulting. They had a consultant come in and say, how do we create a really credible news source so that people will believe our news? It's got a point of view, but we want to be fact-based and we want to be trustworthy. And it would be fantastic if all of those alt-right and alt-left sites would do that. We'd have a much happier news environment. And in the meantime, we hope that if there's a red alongside some of those sites, they're not going to get the ad revenue they used to get, and they won't get the traffic they used to get.
Any last thoughts, Darren?
I think that one of the key things that we believe in is high-quality journalism at Microsoft. It's one of the things that we think is good for society. It's something that should continue to exist. That's why we're investing so much in creating partnerships that work, and we just all need to make sure that we continue to keep that in our minds and keep pushing that forward.
Great. Solving the fake news problem. And now on to lunch. Thank you.
Please welcome Cal Henderson and Libby Kane.
Hi, everyone. Hate to start with bad news. It's not lunch yet. Good news, however, we have Cal Henderson with us, the CTO and co-founder of workplace messaging app Slack.
Yeah.
You may know Slack as, they have 8 million daily active users, over 1,000 employees, offices in 10 countries now, right?
Yeah.
And something you might not know is that Cal has a fun habit. He listens to audiobooks on 2 to 3 times as fast as they're supposed to be, right?
As they're supposed to be? I feel like audiobooks are meant to be listened to at about 2 to 3 times speed. Like when we're having a conversation right now, it's much faster than somebody reading a book aloud. And this way you can get through a lot more books as well.
You've done, 150 this year?
150-ish so far this year. I'm going to try for the 200. We'll see how Christmas goes.
Okay, so you're ahead of most of us. So we're here to talk about the future of work. I'd love to kind of start at the beginning and work our way through. Here you have a really fun story about how you first met your co-founder and CEO, Stuart Butterfield.
So back in the very early 2000s, Stuart had started a company to make an online game, and it wasn't the right kind of time to be making an online game. So they weren't a thing already, and it was like a terrible financial environment in which to start a very speculative kind of venture. But I saw it, and I knew that this was going to be part of the future of the web, was communicating, collaborating with people over the internet in a very social kind of way, in a thread that has gone through all of the companies that we've started since. And so I just harassed him for a couple of years into letting me work on this project, and eventually kind of broke into their internal email mailing list and joined it to get more information about the company, but in a way that's definitely not illegal.
So if somebody did that to you now, do you think you would have the same reaction as Stuart had back then?
The world has moved on a little bit since then, but I think that probably our security team would appreciate learning how they did it.
Fair enough. I mean, speaking of moving on since then and growing since then, you started Slack with 4 co-founders. Now you have about 1,200 employees, over 1,200 employees. How has your leadership strategy had to change as your company has grown?
My role has changed hugely because when when we were a startup with 4 and then like 10 people, you do everything yourself. The first at least year and a half of the business was really just building a product, and everybody was hands-on, constantly building the first version of that product. I think that once you really build a product that people can use and fills that need and that people love, then you can start turning that into a business. So definitely the product piece comes first. But then as the company has evolved, there's really been this having to unlearn a lot of habits. So I'm an engineer by trade, and so I'm used to very strict regimented routine. It's like I wake up at this time, I go to work at this time, I then write code for this amount of time. And as the company has grown, kind of through all of these stages and cycles as it gets bigger and bigger, it's been a constant learning to undo everything I know about how I work. And becoming, I guess, making my job redundant constantly, figuring out what it is I do and how I can split that out into many more people to scale. And then to the point where role as a leader largely becomes one of delivering priorities and vision. And however many times you kind of talk about what's important and where the company is going next and things we have to work on, you have to keep saying that over and over again. And once you're really, really sick of saying it, that's when people start to really hear it.
So now you're at a point where your biggest competitor is Microsoft. That's wild. I mean, was there a moment when you looked around and you said, wow, we can do this, we can take on Microsoft?
I think the whole experience of the last few years has been a lot more like, you know, when you slowly boil a frog, and they don't realize that the water's getting hotter and hotter and they're gonna die. That's a terrible analogy. But like a version where the frog is a lot happier over time. So like a frog sauna. But it's, because it's been so incremental, there was never a point at which like, now it's big. But I think that when you start a, you know, like product or service startup, you always have to have this irrational belief that you are definitely going to be successful. That what it is you're building is inevitably, people are going to love it, people are going to want it, and it's going to be a huge success. You have to believe this even in the case of evidence, like all of the odds are against you. We'd failed in our previous company to make video games, but this time around, we're definitely going to be successful. And it's all very well believing that yourself, but I think it's huge validation when a competitor the size of Microsoft enters the same space and builds a similar product, because they're saying, yes, we actually believe that this is a product space which is going to continue and to be important, you know, into the next decade. So it's very validating. But I think it's also just important to have competition. You know, it really focuses us as a company on delivering the best service that we can deliver.
So you have people all over the world using Slack. Have you seen any differences in how people outside of the US use Slack?
I think what's kind of been surprising to us is when we started the product, we thought that it would just work for small technical teams like us, and didn't really have any vision of where it could be used outside of, you know, kind of like Bay Area tech startups. But what happened very quickly was that it was adopted by teams at all kinds of companies, all kinds of size of company across all kinds of industry. You know, like media was a big industry for us, but now also like healthcare and finance and manufacturing, consumer packaged goods, government. We have, you know, customers like 21st Century Fox or Target or Liberty Mutual. But the same thing has happened outside of the US as well. Our second biggest market is Japan, where it's had huge adoption across all kinds of industries, which has been really weird, because I wouldn't necessarily have expected it, because there's this kind of very different work culture in Japan, very strictly hierarchical, especially around the control of information flow. And a product like Slack is very much about increasing transparency in the share of information inside the workplace. But there's also been this trend in Japan over the last few years, or many years, of people becoming more and more lonely at work. And there's this, I forget what the Japanese word for it is, but this concept of death by overwork, that's seeing people like high suicide rates and people die young and don't have kids and overwork themselves like crazy. But that people feel hugely isolated in the workplace as well. So I think we've kind of come along just at the right time to be able to join this wave of people wanting to feel more connected to the people that they work with.
And that's actually a really interesting point, because I had read that you'd said when you have 15 spare minutes at work, you'll go talk to somebody, hear what's on their mind, that sort of thing. So I was dying to ask, you know, how do you choose when to talk and when to Slack?
It's a good point. I think that, you know, face-to-face communication is still so rich that, like, that's, I hesitate to say never, but it feels like that's never going to be replaced by, like, technology intermediating that. And it's, you know, we still get together whenever we can, but as teams and businesses are increasingly distributed, you know, around the country and around the world, being able to close that gap between the rich interaction that you get with somebody face-to-face and the, like, faceless interaction that you get with somebody over email, I think is really important. And part of that really is that you know, one of the concepts at the core of Slack is the use of channels. So channel where a discussion and communication are organized around a topic or a project or a team. With email, you know, the default is one-to-one. So you send a message to one other person and it goes to die in their inbox. If you send a message to a channel, it might still only be to the one or two people who you intended that message for, but it's there as kind of ambient information for anybody else. That somebody joining the team later can understand not just the decisions that were made, but why they were made and how those decisions happened, and really how work happens at that organization. That's something, when you join a new company, you learn by osmosis over time. You learn how that work happens and how a team interacts. But that can be enshrined in the archive as a team uses Slack.
And so, top of every headline right now is privacy online. And as a workplace messaging app, employers have settings on Slack, in which they can monitor employee activity, flag keywords, that sort of thing. I'd love to know, how does Slack think about privacy? How do you approach privacy?
I think because we are a tool for the workplace, we have to comply with the relevant laws and regulations in each of the territories we operate in, and the rules around the expectations around privacy of communication in the workplace has been somewhat laid down by the last few decades of email, that there is no expectation to privacy for workplace communications. But we still want to take it a step further with Slack, so we make sure that you can see whether your work Slack instance is set into a mode where your employer can read that communication. It can, if your company gets subpoenaed and you will have to produce that communication. So we still work within the framework of the law and the jurisdiction that we're in. But I think it's important for people to understand whether their boss can see those messages.
Absolutely. So to back up a little bit, you were one of the an early blogger in London. What was that, maybe 20 years ago-ish?
Yeah, about 20 years ago.
Yeah, so knowing how much things have changed since then, don't even need to go into that, what do you see for the future, for the next 10 years, or 20 years in the internet? What do you expect next?
It's so difficult to predict out that far, that we overestimate change over the next 5 years and massively underestimate it over the next 10. I feel fairly strongly that we're not going to be in a super VR future in the next 10 years, that people at their desks in the workplace aren't going to be wearing VR headsets and shouting at Alexa at their desks. But it's hard to imagine how it is going to evolve. The shift to mobile in the workplace happened really, really quickly, from it being a constant drumbeat of, next year is going to be the year of mobile internet, and that just seems so dumb. And then suddenly, everybody is working in both modes. I have no idea what the next big change is going to be, and I think it's going to be super hard to predict. But I think what we definitely see is that one of the big trends in the workforce, or in the workplace in general, is that more and more jobs are moving to information work, and that all information work is teamwork. And so to the extent that we can help teams of people communicate better, that can help the output of any kind of organization. So Google released a study earlier this year where they looked for more than a year at what made teams effective, whether it was the management structure or the tenure of the employees, or whether they were all-stars in a particular discipline. And the only thing that was a predictor on whether the team would be successful and high output was how well they communicated. And so the key to high output is just team cohesion and communication.
So when I told my coworkers I'd be speaking to you today, they all had the same question. They say, speaking of mobile, working via your phone, they say, I have Slack on my phone. Does a product like Slack mean that we're destined for the 24-hour workday? Are we doomed? We have forever?
I think definitely the rising role of cell phones in the workplace has meant that it's really easy to be always kind of working. And I think that's super unhealthy in the long term. And I think that maintaining that separation between work and not work is very important for people's mental health, to be able to have a sustainable work culture. So from early on, we've tried to build in features to allow people to manage their time. So we have do not disturb hours to say between these hours, and by default it's overnight, I shouldn't receive any notifications. I try not to ever DM my teammates late at night, because it sets an expectation that they should be working or they should be able to respond immediately. And we added custom status to let people know, I'm traveling today, I'm on vacation, I'm sick, please don't message me. But I think there's definitely more that we can do to help people have that separation. I purposefully try and have a very hard separation. I have 2 kids, I have a baby right now. It's I really value being able to be at work and then not being at work, and I think that's super important.
And we have time for one more question. Speaking you as a father of 2 young kids, and speaking of the workplace in the future, what are the skills you're going to make sure that they have to enter the workplace of 20 years from now?
I don't know what the technological skills are going to be that they need, but I think that whatever the workplace looks like 20 years from now, we're still going to have to work with other humans. And so the most important skills are those communication, collaboration skills. It's empathy and courtesy as values of being able to work together with other people.
Perfect. That's all we have time for. Thank you so much, Cal.
Thank you.
Please welcome Joey Levin and Nicholas Carlson.
Hello. Joey, where are your shorts?
I retired my shorts a couple of months ago, actually.
So we have some charts to look at. Let's see if they happen. But we're talking about surviving and thriving in the kill zone, and this kind of shows that you're doing that. It looks like this one is you versus all sorts of things. What are we looking at?
This is IAC really since inception. So you go back to 1995, and inception was when Barry took control of a company called Silver King, which was a collection of antennas, or antennae. And that, if you had stayed with IAC for that whole period, what the returns would look like relative to some benchmarks. So one is S&P 500, the other is Berkshire, and it's kind of interesting to see a meaningful outperformance. And the reason that this is interesting, I mean, I think it's an incredible story, but also the way IAC is organized and the way IAC works and the way we think about the world is we don't have our scorecard all in one simple stock chart and one simple company because we've spun off lots of companies. So if you look here, there's 10 different public companies that emerged from what was that one original seed. And that's kind of a little bit of how we think about the world, in that it doesn't always have to be in one neat little pile. We can mix things up a little bit.
It's a fascinating, odd, strange, successful business where it's like sometimes you own this thing, then it goes away, and then now you're buying a new thing, and then it's all kind of under the under the IAC brand. Let's look at the next chart. So here, again, the topic of this interview is surviving and thriving in the kill zone, and so you can see, and what we mean by that is, the duopoly, the giant Amazon, and throw that in there, FANG, right? How are you doing this with these giant companies that are, they have huge advantages?
Yeah, well, I think they're totally unrelated. I mean, we've got them on the chart, but it's, the two things happen entirely independently. Look, IAC is really focused for at least recent history, last decade or so or more, on consumer internet. And I think we've been very good at that consumer internet. And the reason we've been good is just because we've learned as we've gone, and we've had the opportunity to look at lots of different businesses, lots of different brands in lots of different categories, and see how the effects of successful brands play out. And we've generally leaned into that when we see things working and been able to capitalize on it. But we have always existed, I mean, this is relative stock performance, but we have always existed in our businesses have been relatively smaller than the massive platforms like Facebook, Amazon, Netflix, Google. So
I spoke to a former colleague of yours, and this person said to me, ask him about being a real value guy, a real Berkshire, Warren Buffett. But as we saw, you're outperforming Berkshire, but how do you take that when I say that to you? Does it feel good about that, or is that what,
It's
is it accurate?
I mean, the second part I think is kind of irrelevant. The first part is people talk about value a lot of times, especially when they talk about it in internet. It's like a dirty word, and it means cheap, and it means like there's no such thing as value. Everything's about growth. We believe you can have both value and growth, and value is not value does not necessarily mean cheap. Value does not even necessarily mean profitable. Value might mean that you see everybody believes it. Any investor anywhere, any operator anywhere is focused on value. A venture capitalist who's investing in something that will, won't show profits for 10 or 15 years is still focused on value, the value they're in versus the value they get out. And for us, value means the same thing. Sometimes it's lower growth things, sometimes it's higher growth things, but we want to get good value, and that we believe we can increase value in whatever it is we're looking at over time.
So what makes IAC the right owner for a company? I mean, I look at it, and a lot of times you'll hear from management, we're not gonna go buy stuff because it's gonna be a giant distraction. But it seems like all these transactions are happening. What makes a company in IAC, what makes IAC the right owner for so many different companies? What's like the DNA, the core?
Yeah, so one big distinction or thing about IAC is we operate on a forever timeline. That's both in terms of acquisitions and the way we operate the business. That doesn't mean you ignore short term. You absolutely, the job of any manager, something Jack Welch always said, is to balance the short term and the long term. And that's what we do. But we operate on a forever timeline. And what that means is we can't say to ourselves, which other folks do when they invest in a business, either through acquisition or otherwise, we can't say to ourselves, well, in 5 years or in 3 years or whatever, this could be really interesting to company X to acquire, or in 3 years the market could be in a way where we could take this thing public and we could get out of our shares or whatever. We don't ever think about things in that way. We don't, most folks who raise money and then distribute money have to do that over a fixed timeline, 5, 7, 10, whatever the number is.
Venture capitalists.
Venture capitalists, private equity. We say it's a forever timeline. So whatever we buy and whatever we operate, we own forever. And in reality, you've seen the chart. Some things we don't own forever under that umbrella. Some things we spin off very rarely, but occasionally we'll sell an asset. But mostly we believe we're going to operate it forever, which means at some point the cash flow is going to be our problem. You can say the addressable market is tens of billions of dollars, and the opportunity, and here's how you execute it, and here's how everything is changing. But at some point, the thing has to deliver cash flow, and it's on us. It's our problem to actually be in a position to deliver that cash flow, and we always think with that mentality, and that I think is a good level of discipline. But the things that we look for are very big addressable markets and obvious transitions. We say, when we can tell the future. It's not because of genius or anything like that. Everyone can tell the future in certain categories. Everyone could tell the future in travel in the sense of saying, does it make more sense to use a travel agent? You get limited information, have all the wrong incentives, or does it make more sense to have an online OLTA, online travel agency, where you get perfect information, you can look all the information yourself. It's the same thing for a number of our categories today. We look for where that transition is obvious.
Yeah, and when we were talking before, you said an interesting thing about how, because venture capitalists have this timeline where they're looking to get out 5, 10 years, whatever it might be, they can rely on the greater fool theory, right?
Sure.
And you can't.
That's right. We can, that part of the sort of tail curve, or whatever you want to call it.
Let's talk about what the greater fool theory is real quick. I just realized.
Well, it's just somebody will be a greater fool than you and pay a higher price than you, or you could keep selling that same story without actually delivering the story. Yeah. We know we're always going to have to deliver the story.
So let's talk about how HomeAdvisor competed with Angie's List and eventually took it over. How did that happen?
Sure. So just for background, IC is a public company, and IC has 2 public subsidiaries, one of which is now called Angie Home Services, which was the merger of Angie's List and HomeAdvisor. We owned HomeAdvisor inside of IC as a private company, and we merged it into Angie's List, which was a public company. And IAC ended up owning 87% of that company, and the public owned 13%. But it was a phenomenal story in that HomeAdvisor really came from behind in a category, competed very aggressively, transformed a business, and was able to end up with, I think, was a favorable deal for everybody involved.
But the fun part is they didn't want to do this deal.
So when we first started calling Angie's List, we had been tracking the company very closely from the outside because they were a competitor to ours, and they were ahead of us. Angie's List brand is much greater brand awareness than the HomeAdvisor brand. And HomeAdvisor had been catching up, but still Angie's List had basically universal brand awareness. You go to a cocktail party, you say, oh, I work at HomeAdvisor, involved with HomeAdvisor, and they say, oh, Angie's List. And you say, well, it's a different one, but yes, it's very similar. And that was notwithstanding us spending probably 3 times what they were spending on marketing, television, and things like that. And so we were following the company very closely from the outside, and we said they were making, we thought, some mistakes that we could see from the outside, and so we tried calling them up. And I literally was calling myself through the switchboard of the chairman's company. The chairman had a separate job. There was no way to get in touch with the chairman. No phone, no email, no nothing. All we had was the name of a company that he worked at from his bio. We were calling the company that he worked at, saying, is he available to speak? And the farthest we could get was voicemail, which was never returned. The only option we had at that point was to send a letter to the company, which was a letter that said we're open, which is a public letter. It says we're open to acquire the company. And that's when they finally engaged with us to say, okay, we can talk. That didn't work out. We said I can't remember what price it was. They were maybe trading around $6 or something, and we said we'd offer $8 and change or something like that. And they said, no, we're not interested. And then the shareholders got really excited, and it traded way through $8. It traded up to like $12 or something like that. And we said, that's not interesting to us anymore. We were interested at $8 in that neighborhood. And so everything fell apart. But we had been studying this company so closely. Our management team at Home Advisor said to us, this was in the beginning of Q1. They said, the company is making some promises right now to their investors. And they are, as far as we can tell from all the stats from the inside, the outside, whatever their promises, they're not going to be able to keep. But it won't become clear until Q3. And so we sat and watched from Q1 to Q3, and I kid you not, in September, which is right in Q3, September of that year, we get a phone call from the investment bank saying, hey, the company has decided to sell itself.
We've changed our mind.
And they changed their mind. And we had been prepared because we had been sort of modeling this whole thing every quarter, and they called us and said, we're prepared to sell ourselves. We said, sorry, we're not interested. We said, we know what's under there. We think it's pretty clear that people are going to realize what's under there, but you're going to have to tell them what's under there so that the price is in the neighborhood.
Now you're interested.
Right. Yeah. So we went away, they went away, and then they called us back maybe a month or two later, and they said, now this is really going to transact. So all the information had gotten out there. And now
what were you doing in the meantime, though, to get some of it?
Well, we were competing. So they were based in Indianapolis. We were based in Denver. We were building. We have sales centers all over the country, and we needed to pick a new country for a new sales center. So we decided Indianapolis, and there were some people with some experience in sales in our category in Indianapolis. So not only did we open the sales center there, we put up ads all around the city saying, hey, come work here. And by the way, you can do a lot better here because our system works. Our product works really well. It works really well for it works really well for our customers. And you want to join our team, you can make more money, you can do better. And we got floods of people coming in. Such floods, we were hearing stories that there was managers throwing chairs against the wall inside of their organization. We thought the top salespeople. We had 4 different people come to us as the #1 salesperson for Angie's List. But we built that business. We built that sales center very quickly. We started getting real results out of that sales center very quickly, and we were very focused on winning. And so we were, I think, tough competitors. But at the same time, when we went to do a deal, and this is really a credit to Tom Evans, who subsequently, after the early stuff, became the chairman of the company.
Of Angie's List.
Of Angie's List, yep. We said, notwithstanding all the history, whatever, we have a vision for this. We think we can do some amazing things with this company, with this brand. We think, and Angie Hicks as well, who's still involved with the company and on the board, we think we can help this business grow. We think we can really get the combined thing in a really favorable position in the category overall.
And to be clear, you offered them a tiny portion.
Well, we ended up doing an 87%, 13% deal, and people were calling us right when we announced that, said, well, I don't understand. You are only 60% of the revenue, or you're only, they were 40% of the revenue and get 13% of the company, or 40% of the profits. I forget what the numbers were, but it was something. But the difference was we had a vision for the company, and we said, look, you can get hung up on all those issues, which maybe you will, and we won't do a deal, which is fine. Or you can realize that you've got a thing that's $6 or $8 a share, and maybe you can sell it to somebody else for $8 a share. Or you can throw in your lot with us, and this is exactly what we're going to do on exactly this timeline. And if you do that, we think it's going to be worth materially more for your shareholders. So you can it's either get caught up in the right now or focus on the longer vision. And again, credit to Tom Evans and Angie Hicks and others. Said, we see this vision, we see the value that can be created here. Now the stock's at $18 or $19 a share. Massive value creation for their shareholders, and I think we're just beginning in there. I mean, we've got this unbelievable combined company, and the thing is thriving, and everybody's winning.
How do you have a rough and tumble thing like that? That's tough. That's fun. Then you get it together. Okay, now we're on the same team.
Yeah, that is sometimes a challenge, but again, everyone, the leadership of Angie Home Services now, Brandon Ridenauer, and just recently a guy named Chris Terrell, they're super class acts, and they can put all that stuff aside. Same with the leadership on the Angie side, and say, let's focus on the vision forward. We're able to compartmentalize these things. We could be suing somebody on one side and partnering with them on another side. It's the reality. The lawsuit is about we disagree on something, and we'll let a court figure out who's right in that, which is fine, and we can agree on other things and focus on other things, and I think that's okay.
It seems to me that that's the core IAC thing, which is just this confident grasp of what you believe the reality is and not getting caught up in stuff.
Yeah, and being organized and willing to be opportunistic.
Yeah. All right, well, thank you, Joey, so much for your time. This is
Thanks
great.
for having me.
Please welcome Scott Galloway.
Good afternoon. I have 143 slides, 1,500 seconds, and I got off a plane from Florianópolis, Brazil 192 minutes ago. If I collapse, just throw water on me. A statistician at NYU Stern told me that if I'm ever in a room with more than 300 people, there is a 46% chance I have students who have taken my class in the room. Has anyone taken my class? Could you please stand up? Stand up. I saw you in the... Outstanding! Great to see all of you. I don't like to ambush people. People think when they're seeing a professor, they're going to be watching someone wearing a cardigan talking about network value and disruption. I am profane. I talk about sex, and I'm very political. If any of these things offend you, I am not insulted. Feel free to leave. You've been warned. These are my predictions from last year. We like to hold ourselves accountable. Just as Eisenhower said that plans are useless, but planning is invaluable, I think predictions are useless, but predicting is invaluable. So we like to revisit our predictions. These are the predictions from this stage exactly 12 months ago. Win, loss, and time means we don't know yet. I thought Amazon would surpass Apple in value. Got that wrong. Still think it's going to happen. The most transformative device in the history of modern business is this, but the baton has been passed to Amazon's Alexa, the new most transformative device. Look at the last product launch of Apple, Critics. Let me summarize the entire thing. You'll never believe it, we have a better phone. Whereas the entire media industry is talking about the voicification of the world. Voice is the most transformative technology since the iPhone, but nonetheless got it wrong. What's interesting is that Microsoft became the most valuable company in the world. I didn't see that coming, and I think there's two lessons here. One, the diversity of the revenue stream, and two, the marketplace loves monogamy. Specifically, it wants consumers to enter into a monogamous relationship with the company in the form of recurring revenue. Companies that convince people to enter into a monogamous relationship get valued at a multiple of revenues, transactional revenues, bigger, better deal, dating, get valued at a multiple of EBITDA. And the ultimate monogamous relationship over the last 30 years has been the relationship between corporate America and this recurring revenue stream called Microsoft Office, and the market loves that. Next big thing, Alexa, I think we got that right. CPG firms unite to fight voice. I think voice is literally the last nail in the coffin of brand. When you think about voice, it takes away the levers of brand building, packaging, pricing, end caps, brand identity, eye height, all those things go away. And effectively, you have whoever controls the voice trading off brands against each other thousands of times a second to try and starch the margin from those brands. That hasn't happened yet. The ad tech market surrenders to Facebook and Google. This is 100% right. There are no successful digital media companies except for Facebook and Google. Every digital media company is hoping that a foreign buyer will panic and overpay for it. Amazon Media Group revenue surpasses Twitter on oath. I think we got that right. Keep in mind this was a year ago. The wisdom here wasn't that conventional. This is Morgan Stanley's
forecast of Amazon Media Group at $4.5 billion for 2018. I don't buy it. By my calculations, or I should say our calculations, Amazon Media Group is going to register almost as much media sales as Twitter, Instagram, and Snap combined. Think about that. Amazon Media Group, almost the same revenue as these three firms. What does that mean? Amazon is now the fastest growing media company in the world, over $100 million in revenue. The e-commerce company is the new media company. If current growth rates hold in 3 to 5 years, Amazon may be the third largest media company in the world. Disney becomes the fifth horseman. Not yet. They have the assets, haven't had the momentum I thought they were going to have. Facebook stock peaks. Said this in January 2018. I think we got this one right. Actually, I think we got this very right. Walmart becomes the online grocery leader. I think we got that right as well. This is when everyone was obsessed about Amazon and Whole Foods taking over the world. And Walmart, click and collect. The most exciting thing in retail is click and collect grocery from Walmart. The net promoter scores on Walmart grocery are up here. It's fantastic grocery. The net promoter scores on the in-store experience at Walmart are down here. So it's genius and wildly accretive to shareholders to let them. I got this wrong. Europe bans Apple, Amazon, Facebook, or Google. I would argue that this is happening.
How may we serve you, gentlemen? Inspector Hank. By order of the Commissioner of Police of Broca Province, I hereby place you under arrest for the murder of Madame Celine Villeneuve de Goffin Taxis. I knew there was something fishy. We never got the cause of death. She's been murdered. And you think I did it? Hey!
We now have the CEO of a Fortune 500 company that probably, if he flew to London, would be arrested on deplaning. It refuses to testify in front of Parliament of our two biggest allies, and yet CNN, Bloomberg, AP call me every day and say, what can Mark and Cheryl do? And I'm going to answer that question. What can they do? This is our big crisis where we're staring at our navels. What can they do? I predicted the breakup of the four would begin, and I think that's happening. I think you're seeing Europe go gangster on them. They register all of the downside, the weaponization of their elections, the anti-competitive behavior, the tax avoidance, but they register a fraction of the upside. Of my 170 students on Monday night, 20 will go to Amazon, 10 will go to Google. There are no university or hospital wings named after Facebook or Google billionaires in Europe. All of the downside, a fraction of the upside, which means Europe will go gangster against these guys, and it's already started. We're seeing fines. We're seeing new revenue taxes that basically say, look, your tax lawyers are smarter than our tax authorities, so we're just going to start taxing you on your top line. We're sick of this cat and mouse game where you're the most successful firms in the world, yet manage to break even in every European domain for the purposes of taxes. Befuddled, distracted, and the most photoshopped image and reputation in the history of business, Sheryl Sandberg. And whenever you say anything negative about Sheryl Sandberg, you're immediately labeled as a misogynist or an anti-Semite. The big four are uncoupling from each other. We tend to group them. I wrote a book called The Four, but they are in fact starting to uncouple. Apple comes out of this year reputationally far ahead of the other three.
We at Apple are in full support of a comprehensive federal privacy law in the United States. Our own information, from the everyday to the deeply personal, is being weaponized against us with military efficiency.
This would be similar to Larry Page and Sergey or the Zuck taking an interest in device addiction among young males. It's a little bit disingenuous, but it's been brilliant, and they have, in fact, pulled away from the other three and said, we're not part of this shit show called big tech. The solution. We're seeing immunities develop against media. Books have started wars. Traditionally, most media develop some sort of immunity, or at least that's the optimistic view, against the dangers of that specific medium. And we're starting to ideally see some of those immunities kick in, both in terms of regulation in Europe and in the US. I think you're going to see a small nation outright ban one of these countries. Because who's the idiot here? Italy, who let Google in, Western competitive norms. What's happened to their job base, their ad firms, their media companies, or do you go Chinese and let a tech firm in just long enough to steal its IP and then prop up a local entrepreneur and capture the value domestically? If you're Uruguay or Estonia and you look at Italy and you look at China, who's the idiot? Department of Justice action. We have a proud history of antitrust action in this country that for some reason we have lost the will for. When companies become invasive species, a key component of capitalism is to break them up. For some reason, we seem to have lost the script here. I think some of this will happen. However, the person that is smarter than all of us will likely do a spin, and this is my big prediction for 19 and 20. I think Amazon is going to spin AWS. And on the IPO or on the spin, Amazon or AWS will be one of the 10 most valuable companies in the world. Because right now, how do you play the cloud? The cloud is the fastest, most profitable growing part of technology, but there's no pure play to play it. Microsoft, you have to crawl over a software company. Amazon, you have to crawl over an e-commerce company. Right? Google, you have to crawl over a search engine. If the #1 fastest growing, largest market share, pure play cloud company were a publicly traded company, you would see a multiple that would be head scratching on the day of the spin. In addition, Amazon now has another unit that can subsidize what is effectively dumping in retail, where they can price their retail platform below cost. When the Chinese did it with steel in the 80s, we called it dumping. With Amazon, we call it innovation. But they have a new cash cow now with Amazon Media Group to subsidize their retail platform. Spins work. Spins throughout the history of technology tend to be very positive for shareholders. Depending on which multiple, and I'm not going to go through these, as Henry would call bullshit on me because he knows a lot more about this stuff than I do, but I think you could value somewhere AWS at a minimum of 70 billion and as much as 600 billion, depending on what metrics you applied based on how other cloud companies are trading. The question then becomes, what happens to the old Amazon? And I think on the spin, these two firms are worth more than they are as a whole. I think there'll be a shareholder reason, and Bezos will spin AWS prophylactically as he will feel the noose tightening from regulators who are too worried about this invasive species known as Amazon that doesn't seem to be subject to the same scrutiny that every other company in Europe and the US has been under for the last century. Instagram should also be spun. Again, somewhere between 110 and 470 billion in value. And it's gotten to a point now where the company is trading at a forward multiple similar to Coke and P&G, who are growing at 6% a year, versus Facebook, with even its recast expectations downward, is growing at 30% a year. Facebook is bad for the planet, bad for humanity. It is also likely the most undervalued stock in America right now. What's the most powerful process in the world? Is it a solar flare coming off the sun, the source of all light? Is the moment of conception that causes such controversy around the moment? When does the moment of life take place? I would argue one of the most powerful processes is when our intentions become our actions. I want to overthrow the government. Is my first piece of content encouraging me to register to vote or to build a dirty bomb? Now, we can't put search back in the bottle. 3 billion times a day, people have one algorithm decide how their intentions are going to translate to their content. I do, however, think it would be healthy to have more competition in search, where right now one company controls a 93% share. So how would you do that? Very simple. DOJ action, and you set the second best search engine in the world loose on #1, and that is you spin YouTube, or you force a breakup of YouTube. First, corporate strategy of the newly independent YouTube meeting, looking for growth and wealth creation on their own options, trading solely on YouTube prospects. Might they decide that, I know, why don't we get into text-based search? And then Google would decide to get into video-based search, and overnight we would likely have 60 or 70% share to Google and 20 to 30 to a new player. Competition is good. Trust busting isn't socialism, it's the core of capitalism called competition. Big health. The industries most ripe for disruption are the ones who have grown their prices faster than inflation. Media did this for decades, stuck out its chin, and the fists of stone, and Google and Facebook were there waiting. So what are the next industries waiting to be disrupted? The obvious one is education. where these 170 students pay $6,000 a night, or approximately $1.1 million to listen to me do this for 12 nights. I'm good, I'm not that good. By the way, my agent takes a 98% commission. The other place most ripe for disruption is healthcare, and this is where you're going to see big tech go. People are dissatisfied, prices keep increasing, and our perception of the value we're getting keeps declining, which makes it ripe. We're already seeing it with retail's intersection with healthcare in the form of urgent care that is exploding, and also is taking on a corporate feel, private investors, more of traditional funding economics as opposed to the nonprofit economics or large-scale economics of traditional big health. We're seeing tech companies make increasingly and very covert investments, both financial and human capital, bringing in world-class cardiologists, buying online pharmacies. It's clear that big tech is sniffing and moving into health. Amazon puts out a press release with JP Morgan and Berkshire Hathaway saying they're thinking about looking at healthcare. We don't know if that means discounts on Equinox memberships for its employees, or they're starting an insurance company, or reinventing the hospital, but the next day on the opening bell, the healthcare industry sheds $31 billion in value. This is why we should need to break up Amazon. Any one company that can perform Jedi mind tricks on another company and deny it the access to the mother's milk of business capital means the markets are no longer competitive. Who would you buy insurance from? This is where I think we're headed. And I get this call. I got a call from someone who's arguably the most famous investor in the world saying, which of the four, you wrote a book on the four, which of the four would do best in healthcare? All right, Facebook's the easy one, no. No one's going to let Facebook, no one's going to tell Facebook about their diabetes or their STDs, right? Google. I think Google's approach to healthcare, Google's more facile with data, an incredible culture of innovation, but it seems like most of their healthcare initiatives have been mostly sort of moonshot or more CSR, cure death, or things that are more along the lines of philanthropy. Apple is probably the one people would pick. I would actually put that as number 2, and the reason why is that I think we overinflate the value of wearables. Wearables are stupid and going away. The data they collect is nearly meaningless. There's no wearable that makes sense. This is the only wearable that makes any sense. Jawbone, Fitbit, FuelBand, all going out of business. Your Apple Watch isn't a wearable. It's a second screen for your only wearable, your iPhone. In addition, Apple investors have become addicted to profits, which will be a huge liability going into healthcare, which will demand extraordinary capital investment and losses over the short term. And who has that as a core competence? You guessed it, Amazon, which will soon be, in my opinion, the fastest growing healthcare company in the world. Amazon knows how healthy you are. They know your body mass index. They know how well you eat. They know if you're in a monogamous relationship. They know if you have kids, all the markers for a long, healthy life. How thin am I? What do I eat? What pharmaceuticals do I order? They'll soon have knowledge around that. And they're also very good at sitting on top of a pile of data and then insourcing the profitable businesses and outsourcing the shitty businesses. That's what the marketplace is. They're constantly watching the marketplace and deciding, batteries looks like a pretty easy business with high margins. We're going to take that in-house. However, developing high-end, design-driven vacuums, that's a shitty business. We'll leave that to those guys, and we'll just take 8 to 12%. Very good at sitting on top of a large data set and deciding which businesses to be in, which businesses to outsource. This is the perfect fulcrum for an entry into healthcare, to decide what businesses you want to be in, which one you don't, and they'll have the best data set on not only 2/3 of US households, which now have Prime, but on the healthiest households. And this is where we're headed.
Dear Scott, are you aware that Amazon Prime now offers Amazon Health Insurance? We can offer you better coverage for you and your loved ones out a fraction of the price. Say, Alexa, tell me about Amazon Prime Health for more information.
Feels awkward in here right now, doesn't it? I think the future is about recurring revenue bundles. Amazon is the ultimate gangster here. Most companies that have added a lot of market cap have entered into some sort of monogamous recurring revenue relationship with their consumer. Even retailers, 95% of transaction volume goes through Restoration Hardware's membership program right now. We're all headed to a series, in my opinion, the consumer world is distilling down to a series of bundles of relationships similar to what we have with airlines, where I'll fly on a stupid flight from Brazil because I'm part of the Sky Team Alliance, and we'll basically give in to key categories, our health, our luxury, our fitness to one brand or one set of brands, pay them a recurring revenue amount in exchange for great service and what feels like unique treatment. So Nike is the kind of brand that can pull together a Rundle, have a set of pre-approved hotels, pre-approved diet. When I die, or my last 2 weeks, I've decided I want to check into the Mandarin Oriental floor at Columbia Presbyterian. There's an opportunity for brands to extend well beyond other parts of their ecosystem, charge one fee, and coordinate across that different bundle and make your life easier. People say choice is a function of consumer value. No, it's not. Less choice. But being confident in those choices is where the real value is. Republicans don't buy sneakers, is what Michael Jordan said. But if you look at what's happened, the majority of wealth or new wealth creation has been captured by Democrats. And that is part of the reason for the revolution we're undertaking right now. If you look at a wealth map, it's like looking at a political map. All the real wealth creation is happening in areas that are strongly Democratic. Who do we have? High school valedictorians, 70% are women. Same-sex couples make more than $60,000 a year additional than heterosexual couples. College graduates earn over $1 million plus. So show me a same-sex family with a high school valedictorian who went to college. I'll show you a Democrat. What this means is there's a business strategy. All these firms going woke on us has nothing to do with principles. It has to do with economics. It's a smart strategy. Because all those people burning their Nikes after Colin Kaepernick had to take that Discover card, go to the store, and buy their first pair of Nikes to burn them. So we're starting to see woke as a business strategy, where all of a sudden people are finding their democratic principles. Why? Because Democrats have all the money. This wasn't a contest, it was a con. I'm talking about HQ2. This is me taking a victory lap and boasting. This is me in January. The new headquarters are going to be in the metro area of New York or DC, because that's where a 53-year-old man worth $105 billion wants to spend more time.
You come right out with and say they're going to the DC area.
It's either going to be DC or New York. I've been on a dozen public and private company boards. The CEO always cloaks the strategy of the second headquarters in business issues. It only comes down to one thing. The number one reason companies move headquarters is simply where the CEO wants to spend more time. The next headquarters for Amazon will be Washington, D.C., the metro area. And the reason why, and it was always going to be D.C., is one, the Bezos have a home there, and a CEO always gets to pick where the company's second headquarters are going to be. And two, the only thing standing in between... You get the idea. This wasn't a contest, it was a con. By the way, the Bezos own 3 homes, and shocker, they're all within 6.5 miles of the new headquarters. This was nothing but an elegant transfer of wealth and funds from municipal fire, police, and school districts to the headquarters of Amazon. This was a ruse. It was an abuse of the Commonwealth. It means Jeff Bezos and his board lack character and they lack code. You got to admire the genius, though. How many PR hits and media hits would I know, put out a press release saying we're opening 2 more offices? Instead, let's gamify it and brand it and call it HQ2. The tariffs got 2.5 million hits, US tariffs on China. This is how many hits HQ2 got. Identity, I think identity is going to be good. I have 90 seconds, so I got to roll. This is the Black Mirror. I'm not going to play it. But you see where we're headed. China's moving towards a social credit score where your behavior and who you associate with gets you lower heating bills, or, on the negative side, the inability to fly or get on trains, as they don't want your poor social behavior to infect the rest of the citizenry. We've been doing something similar with credit scores. It's now moving into the social ecosystem. I think identity is going to be a huge topic in 19. It's become a weapon of trying to figure out a way to suppress the vote in the US. So the question now becomes, how do we develop these immunities? And this is my attempt to be optimistic here. I do believe that we are developing immunities. What do we do about Cheryl? Super easy. We fire her. And that is not a crime against humanity. There are people fired every day for a fraction of the infractions of Ms. Sandberg. It's not an affront against women. It's not an affront against innovation. It's an individual who failed to do her job and protect the Commonwealth. She's made $1 billion. She's going to be fine. Ultimately, the person responsible is the CEO. We should also fire Mark Zuckerberg, but we've fallen under this false flag that he cannot be fired. This is the most dangerous and spineless board in America right now. I have been on boards. I've been on 7 public company and 9 private. And occasionally, a majority shareholder shows up and throws their weight around and says, just a reminder, we control all of you and you better do what we want. And we generally say, well, until you fire us, we're going to do the right thing. And that's the right answer. Board members are supposed to be fiduciaries for the Commonwealth, for teens, and for shareholders who have seen 1/3 of their value shed because of the irresponsible, reckless, and negligent behavior of the Zuck. He can be fired. Facebook board decides to hold the hands of each other and put out a press release saying they're removing him as CEO and kicking him up to chairman. The next day, he could remove the entire board. But play that out. What actually happens when that press release hits that they've unanimously removed him from CEO role, and the next day he fires his entire board? I think that would be a 5-alarm fire inviting regulators, legislators, and governments. I do not think he will burn his castle to save it. So yes, he can and should be fired. The CEO of Nissan is in jail right now for expense impropriety. The CEO of J.Crew has a disagreement with his board after growing same-store sales and has been fired. And yet, we weaponize our elections, depress our teens, but what can we do about Mark and Cheryl? Well, it's pretty fucking obvious what we can do. My final prediction from last year was that the world becomes a better place. I was wrong. Just to the crew here, I'll go another 90 seconds and I'll be done. This is the most famous metric in the world, and it's one of the most damaging things in the world because it gives us the illusion we're doing well. This is a metric on the top 10% of income earners in the US who hold 90% of the stocks. So great, the top decile are doing really well. Spoiler alert, this is a more accurate metric. For the first time, we have life expectancy, which is, please go back a slide, which has declined 3 years in a row in non-war. 3 years in a row, our lifespan has gone down here in the US, mostly because of opioid deaths, with all these unmarked graves of people who are neither wealthy nor politically connected. We're in the best economy in the last 30 years, but I know, let's grow our national debt faster than ever before. What passes as bipartisan behavior is just reckless spending. It's literally as if we met the future and said, hey, future, fuck you. I want mine, and I want it now. Fidelity, patriotism, humility. Where have these gone? Who embodies that now? My last prediction last year, we don't know yet. I predicted who 2018's Time Man of the Year, and this falls under the rubric of immunities, but I'm sticking to this. I believe this will be 2018's Times Man of the Year. I don't have time to wrap up. My name is Scott Galloway. I teach at NYU, and I appreciate your time.
We will now be taking a break for lunch. Programming will resume at 2:15 p.m.